It's an economy that's starting to move from recovery into an expansion phase.
As the Fed tries to remove this accommodation, which isn't going to be easy, you will see market disruptions.
Inflation is going to run hotter and longer than the Fed anticipates.
Could we have several years of much higher inflation? Yes.
In the end, I think the Fed is committed to the mandate, and the mandate obviously looks somewhat different now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. It is a simulcast. We welcome all of you from our world headquarters in New York. Lisa Abramowicz and Tom Keene, sleepless in New York. Matthew Miller joining us after a good 8 hours sleep in Berlin as well this morning. Mr. Ferro, we await his return. And what we do know is when you think it's a snooze fest, it's not. Lisa, that was something yesterday.
Humility, and you know what, markets don't get too complacent in the fact that we will never move. Yeah. Those were the two messages that the Fed was sending. Yes, they're watching the data. At the same time, they are willing to move potentially even twice in 2023, which was a big surprise to markets. Tom.
Really interesting. It's substantial. We're gonna have a substantial surveillance today, and really it goes, Lisa, to the pendulum of SFB. Let's bring it out right now, Lisa. What does substantial further progress mean? I have no idea what that means.
Substantial further progress, frankly, it's a question mark whether they're looking more to the inflation, which is what they raised yesterday. It was very clear they were more concerned about inflation than people previously thought. But really, with respect to the labor market, are they talking about an overall headline number, or are they talking about the composition of jobs, especially given Jay Powell's comments on how things are changing, why there are people still out of the workforce, and what it will take to get them back?
We've got a terrific set of conversations today. Brian Moynihan and David Weston will stop by. Mr. Moynihan setting up my Christmas Club account. David Rosenberg in moments, really the interview of the day on inflation. Alan Ruskin of Deutsche Bank will be with us. And Matt Miller, speaking of Deutsche Bank, you look at the data screen, and I'm sorry, the euro speaks volumes. What did we learn from Philip Lane this morning on Bloomberg?
Well, what I think is interesting is the euro move against the dollar because of Deutsche Bank's cut, because of Goldman Sachs's cut in terms of the dollar continuing to gain, the euro being held back a little bit. I don't think the Philip Lane story is as interesting as Villeroy a couple of days ago when he said, look, we're going to focus on the currency. That's our only focal point right now, is keeping this currency together. And if you don't, you end up like Argentina. And I don't really hear central bankers too often talking that explicitly about the currency.
On the same page, and George Saravelis at Deutsche Bank saying they now skew short-term to a stronger dollar as well. Matt Miller, let's run through the data. It's a radically different Bloomberg terminal this morning. We're not going to spend all the time on this to get to Mr. Rosenberg. I'm just going to go to the 10-year real yield, Matt Miller, and the answer is moonshot from a negative 0.90 up to negative 0.77. Ginormous move.
Yeah, that's USGG 10. Why?
Very.
What is the ticker you use for that real yield? Because you're not just taking
USGGT.
USGGT 10. Because you're not just taking core CPI out of there. You're looking at it with the forwards.
We got a full ticker here, but let me first say futures negative 13, Dow futures at negative 98. The VIX comes back 15 out to 18.31 with dollar strength this morning. Lisa, give us a brief.
All right, this is what we're looking at. You mentioned it, Tom. 8 a.m. We've got Brian Moynihan joining Bloomberg Television. Our own David Weston swooping in to do that. Really interested to hear what he says about the yield dynamic that you're talking about. We saw huge moves in the belly of the curve yesterday, the 5-year note in particular. 2-year yields surged, absolutely surged. They are coming down a little bit today. But the question really is for banks, how much can they increase lending? What does it mean for their outlook if the Fed does take a more hawkish tilt? 8:30 a.m. The Fed will be watching this. So will markets. U.S. jobless, initial jobless claims. To me, this will be interesting. I've been saying week after week. I don't know, noisy. Not necessarily this time. Yes, noisy, but what we will get is a sense of how much more people go back into the labor force as a result of the reduced initial jobless benefits. The idea that several states have actually started to pare back the enhanced benefits. Yes, Tom.
We're going to see if claims make substantial further progress.
Okay, you can be the judge of that. Is that our new drinking game?
No. Although, actually, with the Tang Mimosa, maybe I should make substantial further progress. Very good.
SFB. We could just say SFB and you drink. All right, I'll just keep saying
Isn't it a rule in the NFL?
All right, 10 a.m.
Substantial forward progress.
Moving on. Janet Yellen is testifying a second day in Capitol Hill, testifying before a House committee on budget. And basically, yesterday, the big takeaway was taxes very much on the forefront, talking about capital gains taxes, possibly even being regressive, Tom, going back to April if they pass it later this year. This kind of key for people who are trying to figure out how to position and whether they can avoid paying some of those higher taxes.
There we go. We start strong with David Rosenberg joining us from Rosenberg Research. Thrilled that he could join us. David Rosenberg slices and dices inflation dynamics truly like no one I know. David, we had Jan Hatzius of Goldman Sachs on. He and you are so much on the same page of a slide of GDP back to something normal at some point. If we get a Hatzius sub 3% GDP, what does that do to Rosenberg inflation?
Well, look, I think that if the economy slows down, especially with the fiscal withdrawal we're going to be seeing in the second half of the year, I think what happens in traditional economic terms is the output gap starts to widen again. It's going to bring this inflation run-up we've seen reverse course and should ultimately be very good news for long-duration assets. So that's really what the story there is. But I'll just say, Tom, it was really, I think, less about the dots. The dots have no predictive power. If you look historically, there was the Fed taking this year's GDP growth from 6.5% to 7%. Because, when you look at what's baked in already for the first half of the year, the Fed's telling you that they're expecting fourth quarter growth to be close to 5%, which is up materially from what their implicit forecast was before.
What do you have into 2022, though? They've got to get to 2 rate increases the year on, and so much of it depends on that level of GDP. Do we get back to a potential GDP under 2%? Do we go under 3%? What's your guesstimate?
Well, look, the Fed's over 3%. A lot of it depends on the fiscal backdrop. But I think the fiscal withdrawal is so enormous that you're going to have. I mean, the Fed is implicitly assuming that private sector demand is going to be over 6% next year. I am nowhere close to that. I think the economy is going to slow back below trend, starting probably in the third or fourth quarter of this year. So I'm back below potential growth for next year. And as a result, that reinforces my view that inflation is going to come back down more than people think.
David, do you think that the Fed is committing an error here?
Well, it's too early to say that. It's situational, and everything is really about, now moving from 2023. And so it's still a few years down the road. To say the Fed's going to make a mistake right now, they haven't really done anything. They're talking about tapering, which is maybe happening earlier than people thought, but they haven't done anything. They've just, laid out.
Okay, I guess that, David, will it be a mistake should they follow through on the median dot plot projection there of hiking rates twice in 2023?
Well, I think it probably will be, but that's based on my assumptions. And even on the FOMC, take a look. There's still a wide range of opinions. People look at the median dot plot. Not everybody is centered on the median. So I'd say that they haven't made a mistake yet. I thought that it was surprisingly either less dovish than I was certainly thinking about, but they haven't done anything yet. Look, when you look at the dots when they were first introduced by Bernanke in early 2012, the funds rate was pressing against zero. For the next 2 years, the dot plot showed 0.75. They were going to hike rates 3 times. So we know with hindsight they never did that. And I guess if they raised rates 3 times, it would have been a mistake, but they never carried through on the dot. So to say that they made a mistake, way too premature to say that right now.
David, you, though, don't see the inflation, right? In your notes, you talk about 20% of CPI gets all the attention, and that's up, but 80% of the index is not accelerating. And if the Fed is even thinking about raising rates, why would you like gold here?
Well, look, I haven't been banging my fist on gold for months. It got dramatically oversold at the lows several months ago. It's backed up, and now it's rolling over again. A lot of the gold analysts are saying we can correct all the way down to 1,600 in the context of what could still be a secular bull market in gold. Nothing moves in a straight line. But, you folks were talking earlier about the backup or less negative results in real rates. Well, gold's got a time-worn relationship with real rates, and if real rates back up here and the dollar continues to strengthen, then it's not just gold. Anything priced in U.S. dollars is going to take it on the chin, including most commodity prices. So for the time being, as long as real rates back up here, the dollar just broke above the 200-day moving average. Gold is going to remain under some near-term downward pressure. So to say that I'm bullish on gold right now, because I've been a secular bull on gold, right now I'd be saying, that the near-term risks are more to the downside.
David Rosenberg, thank you so much. Greatly appreciate it this morning. He's with Rosenberg Research. We'll have much more from Mr. Rosenberg in the coming days as he writes on inflation as well. Lisa, we need to frame where we are. The real yield, I think people don't understand the trend that it has. For those of you on radio, it's real simple. It's been a massive disinflation coming off 2007. A 20-year chart of the 10-year inflation-adjusted yield speaks volumes. And down we go, Lisa, to a big negative number. And am I right that we've just sort of kind of like teensy weens made it back?
Yeah, we did make it teensy weens back, although I will say that it depends where you are in the belly of the curve, particularly the belly of the curve. That's the 10-year real yield. And it didn't really tick up that much yesterday relative to history, and it's going back down today. With the 5-year real yield, though, however, yesterday was a massive move. The idea here that the Fed may not be sitting on yields, that they actually might be doing the opposite and pushing yields higher, really a dramatic development. And that actually, you did see the biggest move since April. And frankly, you saw those real yields go to the highest since December.
Lisa and Matt, we've got to talk about the President of the United States. Usually it is a quiet return to Washington. And after all that we saw yesterday, and Matt Miller, let me start with you in Berlin because it was hugely continental yesterday. A tour de force press conference in the 88-degree heat. And the president at 78 years old, 79 in November. Matt, what was the spin in Berlin this morning on the President of the United States?
Well, that the outcome was pretty positive. I mean, of course, they're not going to be best friends and give each other hugs at the end of the bilat. But Biden gave Putin some Ray-Ban aviators.
I mean, Lisa, Matt is just so international relations.
Do you know what?
Continue with our bilat. Matt Miller here. We're going to make substantial further progress. Good morning.
With the First Word News, I'm Ritika Gupta. For months, Fed officials have said that price increases are temporary. Now, they don't seem so sure. Policymakers have signaled they expected to make 2 increases to interest rates in 2023. That surprised financial markets. Fed Chair Jerome Powell said there is a risk that inflation will be higher than the central bank thinks. Prospects for a bipartisan deal on U.S. infrastructure are improving. 20 senators, including 11 Republicans, have signed on to the framework for a $579 billion package. That's the biggest in decades, although it's a lot less than what President Biden wants. It also includes a plan to index the gasoline tax to inflation, which the White House opposes. Both Joe Biden and Vladimir Putin are claiming victory in the Geneva summit. Putin got legitimacy on the international stage, and the U.S. president argued that he confronted Putin over cyber attacks, Russia's treatment of democracy activists, and the need to cooperate over nuclear weapons. And police in Hong Kong have arrested the 3 top editors at the pro-democracy Apple daily newspaper. 2 of the paper's executives also were arrested. They're accused of breaches of the sweeping national security law. The paper's founder, Jimmy Lai, is already in prison for attending unauthorized protests. The Securities and Exchange Commission has again delayed a ruling on a Bitcoin ETF. Regulators said it will seek more public comment on a proposal to list a product on the Cboe global markets. A Bitcoin ETF could catapult the world's largest digital token into the mainstream amongst institutional investors. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The housing sector is strong, and business investment is increasing at a solid pace. As the reopening continues, shifts in demand can be large and rapid, and bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust. raising the possibility that inflation could turn out to be higher and more persistent than we expect. It's not a time to try to reach hard conclusions about the labor market, about inflation, about the path of policy. We need to see more data. We need to be a little bit patient.
Whatever your thoughts, the chairman of the Federal Reserve System yesterday, a tour de force, negative 300 on the Dow, and he single-handedly stopped the decline and turned the markets around with even green on the screen on NASDAQ there after a while. Lisa, have we answered the question of why Michael McKee always goes last?
Yeah, because his questions tend to be thorny. They do.
Yeah.
I mean, he asks the hard questions. That's what I think.
It's cruel and unusual punishment.
You think it's the way that he looks?
No, I'm just going to write Michelle and the Fed a note and say, have him go first, So where's the courage? Let's make substantial further progress in getting McKee higher in the press conference. Right now, we stagger. We don't make progress. We stagger to Jack Fitzpatrick in Bloomberg. Jack Fitzpatrick, a very tired President Biden, did not stagger down the stairs last night in Andrews. He came in very nicely, elegant, dressed. He had the aviator thing going, I think, dressed all in black. He comes home to a gloomy gridlock. What kind of gridlock does the president enjoy this morning?
Right now, it's essentially a two-track issue where it's not entirely gridlock on his legislative proposals. There are still bipartisan talks on infrastructure. There was an announcement by a bipartisan group of senators yesterday that they agree at least on some basic bullet points of a proposal that appears to be almost $600 billion, but they really didn't put out details. And meanwhile, Democrats are preparing to go their own way and actually are starting to have discussions about the budget documents they'd have to do to put something through the Senate without Republican support. So they're simultaneously trying to get bipartisan support on whatever they can get in infrastructure, but also preparing a partisan plan that goes with infrastructure, the families plan, prescription drug costs. They had a brief conversation about immigration legislation.
You're such a
and really
Jack.
a catch-all for everything they want to do.
You're just circling the infield here of policy this morning. Jack, what is the president's most difficult first call on his return to Washington?
His most difficult first call may relate to those issues, particularly as it relates to taxes. Everything happening in Congress, there is movement on infrastructure spending, but trying to get any bipartisan support for the pay-fors, anything on taxes really hasn't seen much movement. So
Lisa,
that's the toughest issue.
Lisa, summer camp is a pay-for.
Oh, yeah. Well, summer camp needs to get paid for, and you and I are living the inflation. We're living the CPI of that. I just want to bring you some of the developments from what we got out of the Putin-Biden summit. Vladimir Putin telling Biden that he sees cyber attacks as unacceptable. This, according to the Kremlin, to be clear. The Kremlin also saying that Biden didn't accuse the Russian government of a cyber attack role. So that is the Russian perspective. Back at home, when we talk about domestic policy, what kind of brouhaha will there be, has there been, over Janet Yellen's discussion of capital gains taxes, a hot button topic, saying that basically they could be regressive. No, they won't be considered regressive, but they could go back to April if passed even later this year. What's your view on the potential pushback of that?
Well, there was immediately significant pushback from Republicans on the capital gains proposals that Biden put out. That is not going to go away. That's one of the top issues to look for as she testifies today to the House Ways and Means Committee, which is focused on taxes. This is supposed to be a hearing on the budget proposal, but the tax side is very likely to get a lot of attention from that Biden budget proposal. So that's going to be a very tough issue. The relevant question in terms of turning that into legislation and Biden following through on that is, do they work that into a partisan package that Democrats try to get through the Senate? Because there really is not Republican support for that. And can that be used as a pay-for in this next package, aside from infrastructure, in a Democrat-only catch-all?
Jack, when we talk about fiscal spending, have we moved beyond recovery from the pandemic and moved toward furthering President Biden's agenda in a progressive way that potentially might meet more pushback?
Yes, clearly, when you follow the discussions on infrastructure, on the so-called families plan, all of that, the insistence by the president that this needs to be offset, not necessarily over the same number of years, but spend money over 8 years and pay for it over 15. He's not trying to inject more money into the economy. If you look at his spending proposals, it is a greater amount of government spending, but also a significant tax increase. This is it appears to be more of a redistributive approach than what we saw in the immediate stimulus that Biden pushed. It is a significantly different approach that's a tax and spend rather than a stimulus approach that was cast as sort of the emergency response to try to get the economy going.
Jack, are we going to see a lot more pork in the next few bills with the return to earmarks?
The earmark debate is going to be very interesting to watch. They emphasized so much to lawmakers for the infrastructure earmarks and for the regular earmarks in government funding bills. They emphasized so much that this has to be limited. This has to be very, very transparent.
Yeah.
That I noticed they got fewer requests in terms of the dollar amount than appropriators thought they would get. So that's one sign that it might not be as porky as you might think, but it's still something where the political motivation is to find anything that could be controversial and probably hammer away at that. So that is something to look for from conservatives in the infrastructure debate and in any government funding debates going forward.
Jack Fitzpatrick nailing the porky debate in Washington this morning. He is with Bloomberg Government. Porky, Lisa.
Honestly,
porky.
The rest of the morning is just going to be porky. I've got a porky mimosa. It's a porky report, literally all morning long. Tom,
right now, I got a major message yesterday, major chastisement, Lisa. You and I have to talk about the Tots appropriating the management of Juventus. I mean, there it is.
I have about as much to say about this as you did about 4 years ago. I mean, honestly, you're missing John Ferro. He'll be back. And you can talk to him all about that. He'll give you lots of insight.
Can I just say,
please,
even if the number of no-hitters in baseball triples this year, I would still rather watch MLB than soccer.
Ooh, those are fun words.
It's so boring.
Okay.
Hot
John
take
from
from
Coventry
Matt Miller.
emails in and says, I'm not coming home. Matt Miller, thank you so much. Greatly appreciate that. I would note the Cleveland Indians struggling this year. We're going to continue, and we're going to continue strong with some wonderful conversations. Alan Ruskin of Deutsche Bank, his colleague George Saravelis shifting to a skewed strong dollar view. Brian Moynihan in conversation with our David Weston coming up later as well. Futures at -12, the VIX 18.27. And John, for you, the Dow 33,800.
He thanks you.
This is Bloomberg. Bloomberg Surveillance, major shout out to Priya Misra and David Blanchflower. Misra of TD Securities and Professor Blanchflower of Dartmouth. They got run over yesterday by the president's press conference. We really appreciate their time taken yesterday, and we'll get them on here again in short order. We've got wonderful guests this morning. Matthew Miller in for John Ferro, Lisa Abramowicz, and Tom Keene. It is Surveillance on a Claims Thursday. Lisa, help me with the data here. The 10-year yield, that's the nominal yield. It's sort of in between. It was like a 162, a 148. We really didn't break out the new 10-year yield highs, did we?
No, although I will say the move is market. We were talking about a sub 1.5% 10-year yield yesterday. Today, the outlook has completely shifted. Yes, we're seeing a little bit of buying after yesterday's sell-off, but I would say the trajectory is higher. And Tom, I do wonder how much people are going to reprice based on the Fed meeting yesterday.
Oh, the repricing's interesting. And Matt Miller, did you see the repricing in the negative yields across continental Europe?
Yes, we did. We saw, well, getting closer and closer to positive here in terms of the Bund yield, not as close as your U.S. real yield, but only negative 17 basis points now. And we saw yields climb in the U.K., climb in France, climb in Italy, so everywhere across across fixed income.
But to the breakout, and that is a conundrum. Alan Ruskin with us now with Deutsche Bank, their chief international strategist. Alan, I look at where we are right now. That what an interesting press conference yesterday. And I've really got to ask you about this phrase, substantial further progress. We're making a joke about it, but on a theoretical basis, out of the textbooks you've used, what is substantial further progress? How do you define that?
Well, Tom, I think what you saw yesterday was that the dual mandate is so important, and that it's both the progress you make on the inflation side, but also, of course, the progress you make on the employment labor market side. And the market up until now has been emphasizing the labor market and the lack of progress there. But I think what you finally saw was recognition from the Fed on the importance of the other side of the dual mandate, the inflation side. So, it really depends on what you're looking at. On the labor market side, I think even there, Chairman Powell was very optimistic when he starts to speak about the longer term view on the labor market. And when you look at the Fed's forecasts on the labor market, including an unemployment rate of 3.8% at the end of 2022, around 4.5% at the end of this year, those are very, consistent with substantial progress.
The substantial progress could be a green light for other central banks, given your international purview. Did he green light other central banks yesterday to begin to nudge rates up as they choose?
I don't think other central banks are using this flexible average inflation targeting regime, certainly not in a religious way that the Fed seemed to be up until yesterday. So I think there's no sort of green lighting per se. I think the Fed was standing out as really looking like the ultra dovish central bank within the G10 group. I don't think it really changes things materially. What you are, however, seeing is that some of the central banks that were leaning to be more on the hawkish side, like the Norges Bank, are now signaling that they will raise rates, not just taper, but actually raise rates in September. So you do have some central banks that are well ahead of the Federal Reserve. They were before yesterday, and they are after yesterday.
We have seen more central banks start to raise rates than cut rates. I think there have been 84 central bank actions globally this year. At the beginning of the year, there were more cuts, and now we're seeing that skewed towards hikes. When are we going to see, though, the big ones follow, or is that the way it's going to be? Is the ECB really going to wait until after the Fed?
Look, I think the big ones are holding back for the most part. I think the ECB is also, obviously said they're not going to taper through Q3. They're also on this attempt to look at things and see how things are going to change. The Bank of Japan is not looking at things for, next 3-4 years, really, in a way. So they're very much on hold. The Bank of England maybe is a little bit more hawkish than the other central banks. But I think when you look at global markets, it's the Federal Reserve. I mean, we just saw it yesterday that, it's what the Federal Reserve does that's going to dictate, I think, on all asset prices.
Lisa had a great piece out yesterday on Bloomberg Opinion about the financial risk that we're seeing, rate risk intertwined with credit risk. And today I saw a story on private equity. They've been pumping more leveraged loans onto the books of their companies than they have in the last 14 years because of these low rates. Is this a dangerous situation?
Certainly for someone like myself who tends to emphasize the asset cycle as, ultimately driving the business cycle, there's, plenty of signs of ebullience, really. And I think the Fed has been very restrained, just to put it charitably, in terms of the way they've spoken about, the ideas of bubbles or bubblettes, et cetera. So I think, the example you cite on the leveraged loan side, I think one could just look in terms of just some of the more orthodox measures. The most most obvious being, just equity P ratios, just to say that, yes, there are danger signs there. And, it's not obviously just asset prices, but now we've seen it in consumer prices. I mean, the danger is upon us, really, in a sense. So, that behooves action. And I think the Fed did the minimum yesterday.
So I want to talk a little bit about the market reaction. We did get an immediate knee-jerk increase in rates as the Fed took a more hawkish tilt. Makes sense. Today you're getting some buying, people coming in and seeing some opportunity. At what point does the international aspect of the bond market, the fact that if the U.S. does tighten, they look better on a relative basis, their yields are higher, the dollar strengthens, people go into these bonds and yields go lower. How much, without the rest of the world moving, does the balance of motion go to the lower when it comes to bond yields, even with a more hawkish Fed?
Well, Lisa, I mean, we just have to think back to Q1, where the bond market was very much in the frame and the bears were, very much taking up the running. And Q2 has been very, very different. And the dynamic there is different because on the supply side, the Federal Reserve has obviously been holding huge treasury balances that the treasury's now been running down. So the net issuance, particularly over the last couple of months, is going to be negative. So that supply side has been very helpful for the bond market. And then on the demand side, obviously got the Federal Reserve dominance sort of taking down, it's close to say 60% of issuance quarter by quarter. But on top of that, over the last few months, but we really have got good data for March and April, foreigners stepped up their game as well. So now foreigners do seem to be interested in U.S. bonds and treasury bonds in particular when you see yields above 1.5%. So previously I thought, look here, the 10-year can easily get to 2.5%. 2s, 10s, 250 basis points is not unusual. But I think what you're seeing in this low yield environment is that foreigners will restrain the bond market. But Q2 has been special because of the issuance side. So I think there's definitely a danger that when we get past this rundown of treasury cash balances, bond yields are going to start backing up in a more material way.
That's really interesting, basically waiting for the taper to actually begin. Just to sort of wrap this all together, did anything change about your investing thesis after yesterday's Fed meeting?
Yeah, I think things did change because the Fed has really been, ultra dovish, really. And, I still think they're dovish. I still think, there's an argument that they should be finishing tapering at the time when they're starting to talk about tapering. So, we're still, dealing with an ultra dovish Fed, but I think they're catching up with the market. And the key element is the Fed behind the curve or not, or certainly behind the market? Because, if they lag behind the market, then, for example, in the FX arena, the dollar will tend to be weak. If they catch up, and certainly if they're ahead of the market, then the dollar is strong. So, we're at that cusp, really, when we're making up our mind just exactly where the Fed fits in relation to the marketplace.
Alan Ruskin, thank you so much. Greatly, greatly appreciate it this morning with Deutsche Bank there. We've got lots to cover right now. An important headline coming out here, folks, of a gentleman we will speak to in a bit. After Brian Moynihan, we are thrilled to bring you one of the most interesting central bankers in the world. Øystein Olsen is with Norges Bank. I believe we have him next, my error as well. And he's talking out in the wire right now, and thank you to Bloomberg for picking up these headlines. Lisa, don't give signals on possible interim meeting changes. I think it's really interesting in that it really shows the unsettled nature of all these central banks joined at the hip with the Fed.
And the idea here of the potential ramifications of moving first, although people think that this is the central bank that could move first. I got to wonder, though, the international quality, the fact that Alan Ruskin saying he sees a limit to how high bond yields could go given the international buyers coming in, at least until the Fed starts to taper. A fascinating observation.
Yeah, and Matt, you look at Euro. We brought this up twice so far. Let's do it again. 119.37. I mean, is the world prepared for strong dollar? 118 euro. I just don't see it. I mean, this is a real shift this morning.
It is definitely a real shift. I was thinking, and because of the analysts and investors with whom I've spoken, that it was going to go the other way, more like 125, which is, I think, the 5-year high.
I'll take the point, yeah.
Yeah, but it's interesting that we've had this shift on the ECB side as well. So if you've got it both on the ECB and the Fed, you can see that puts some real weight behind the trade.
Lisa, I want to get out in front of this important conversation with Brian Moynihan, and you really wonder if he's going to drop news on trading activity at Bank of America. We've heard from, I believe, JP Morgan and Citigroup of a little bit of sogginess there directly from Mr. Diamond and others, the CFO at Citigroup as well. You wonder, Lisa, how this carries over to Mr. Moynihan's shop.
And the expectation is for it to continue since, frankly, trading volumes have been a lot lower. I mean, there wasn't the same disruption. There wasn't the same kind of stimulus. It's allowed to slow down. It was supposed to slow down. Jamie Dimon saying this is normal. And if it were to continue the other, that would be abnormal. I'm actually more curious to hear what he has to say about consumer lending, whether they actually are extending more loans, and also about interest rates, about whether the message from the Federal Reserve yesterday was good for them or bad for them, given the curve flattening and, frankly, their sell-off.
Don't we understand that loan demand is not there? Isn't that a given?
Well, the question is it not there because of all the stimulus that's now being worked down, and then it will pick up? Is that the case? Have we gotten there yet?
And this goes back to Hotsius yesterday, sub 3% GDP.
Totally agree.
Certainly, I'm still focused, folks. All this mumbo jumbo, I'm focused on what GDP is going to be Q3 and on out as well. One of our themes through the summer here at Bloomberg Surveillance, futures at -16. Stay with us. The governor of Norges Bank next.
With the First Word News, I'm Rishka Gupta. Officials at the Fed now signal that they may raise interest rates from near zero faster than they had forecast. Policymakers expect there will be 2 rate hikes by the end of 2023. Fed Chair Jerome Powell acknowledged there is a lot of uncertainty. Powell said there is a risk that inflation will be higher than the central bank thinks. Congress has given final approval to a new federal holiday celebrating the end of slavery. Juneteenth, or June 19th, will be the 12th federal holiday. It marks the day in 1865 when Union soldiers brought word of freedom to enslaved people in Texas. President Biden will sign the bill into law today. It's a milestone for China's space program. A Chinese spaceship carrying 3 astronauts docked with the country's new space station today. The crew will live aboard the space station for 3 months. They'll carry out experiments, test equipment, and conduct maintenance. And a warning from Switzerland's central bank. It says that UBS and Credit Suisse have the potential for substantial losses in case of a U.S. or protracted euro area recession. The Swiss National Bank did say that the country's 2 biggest banks are proving resilient and credit losses remain low compared with international peers. And banks in Asia have a huge problem. They're struggling to hold on to junior investment bankers. An informal Bloomberg News poll of executives at 4 global securities firms found that anywhere between 13 to 15% of investment banking analysts and associates left their roles this year. That's roughly double the average in recent years. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Can we do something to redirect SDRs from countries that are getting it but don't need it to countries that desperately need more help? And I'm so very pleased that now we have the G7 coming up with support for about $100 billion redirected from countries with strong reserve positions to countries that need help.
Dr. Georgieva, the International Monetary Fund, along with Mr. Malpass over at World Bank, getting their wish, which is action by the G7, as she mentioned to Bloomberg yesterday. Lisa Abramowicz and Tom Keene with Matt Miller in for John Ferro. We've got a good set of guests coming up here on a bombshell of a Fed meeting yesterday. This is an important conversation. We do this with futures, a little quiet, -15, in that Norway is different. Not only is Norway always out front with transparency and wonderful statistics, but also out front in terms of the largest sovereign wealth fund, the linkage to oil, and their leadership and monetary theory. Driving that is the statistician Øystein Olsen joins us from their statistics wing, which is the best part of the Bank of Norway, the Norges Bank, and he is now governor of the Norges Bank. Mr. Olsen, you have taken a hawkish shift. Is that a luxury you can take because of your sovereign wealth fund?
No, and my short answer on that issue is no. And as regards ourselves and our monetary policy stance, we don't use the word hawkish. We are seeking seriously to take decisions and make signals for the future which provides a good balance for the Norwegian economy, and according to our mandate, which strives towards price stability, but also to support activity and employment.
With your work and leadership in statistics, and again, folks, I can't say enough about the world-class effort of Norges Bank over 30 years, it seems a measured approach, almost Greenspanian. Can central bankers take a measured approach in rate increases given the recovery from a natural disaster as is this pandemic?
Well, let me start by saying, if I take a broader look and towards the special features of the Norwegian economy with oil activities as an engine, and yes, also the sovereign wealth fund as a significant buffer for fiscal policy. Let's admit that we have been lucky over the years, and also we have had politicians which have handled the wealth in a good way. Coming to the present crisis and the pandemic, it's also striking that we are all in the same boat now around the world. We're all hit by the pandemic. But looking at the statistics, in relative terms, Norway is better off both as regards the outcomes in the health area and as regards, yes, we had a sharp fall in the activity, but it has been milder than compared to many others. I haven't a good explanation for this, especially in the area of health. But this is where we are now. We see a clear recovery of the Norwegian economy. The authorities are opening up the society, and we are on our way to and reaching normal levels as regards activity and capacity utilization. Unemployment is coming down, and given that, it's time to gradually start raising the policy rates from a very low and a normal low level.
I'm curious on the asset side, how you're allocated right now, how liquid you are, and how exposed you are to this shifting interest rate environment.
I mean, you're referring to the sovereign wealth fund now, to the assets.
Yes.
Yeah. Well, knock on wood, so far the development, even throughout the year 2020, was positive. I mean, the equity markets went down for some time, but then markets have turned around, and the returns and results for the year 2020 are quite positive. And this development has continued so far.
Yeah.
But yes, we are exposed to new events. If things happen, if markets are turning around, we have to, as a nation, should be prepared to opposite developments in equity markets and the value of our sovereign wealth fund. And policy is directed to manage that. Governor,
you talk about raising rates potentially in the near future, and yet inflation is not necessarily running hot, does not seem to be in an elevated fashion in Norway. I'm wondering whether that gives you pause about raising rates at this point.
Well, as I say, There's no huge pressure in the economy just now. You're correct in stating that as regards price and wage inflation. But on the other side, growth is quite strong. And we are approaching normal levels, both as regards activity and employment and unemployment. And then it's important to add that we have some vulnerabilities also in our economy. We have a household sector which is highly indebted. Debt has continued to fall during the pandemic. Housing prices did not fall; they went the other way around. So housing prices and property prices in general have continued to go up during the crisis. And there's no doubt that when credit is cheap, and with zero rates and policy rates, that this fuels both borrowing and the housing market. So financial stability issues, we are concerned of that as well as a central bank, and actually that kind of consideration is part of our mandate as well.
Too short a visit. Mr. Olsen, thank you so much. Governor Olsen is with the Norges Bank, of course, in Norway. Lisa, we didn't have time to get there, but I really wonder for them and for their sovereign wealth fund clocking it at near $250,000 per person. You wonder what $74 Brent crude does.
Yeah,
I really wonder how that changes the degrees of freedom of the central bank.
The idea here that they have a lot of income that comes directly to their coffers, that they don't have to worry about financing their deficit in the same kind of way that perhaps the United States.
We're moving. I could see us from Oslo. Bloomberg surveillance from Oslo.
Yeah.
Yes.
I would love it. That would be great. But I would say, I don't know, Tom Keene.
I think
you think that
we
think
couldn't
he'd fit
get
in?
Ferro to go there, but
You think he'd fit in?
I don't know.
Very nice. Very nice.
I see us doing a July show from there. John Golub on the equity markets. Stay with us. This is Bloomberg Surveillance. Good morning.
It's an economy that's starting to move from recovery into an expansion phase.
As the Fed tries to remove this accommodation, which isn't going to be easy, you will see market disruptions.
Inflation is going to run hotter and longer than the Fed anticipates.
Could we have several years of much higher inflation? Yes.
In the end, I think the Fed is committed to the mandate, and the mandate obviously looks somewhat different now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. A post-Fed simulcast on radio, on television. It was not a snooze fest. Powell moves the markets big time with the Fed finally moving towards, I don't know what they're moving towards. We're going to figure it out in this hour. Jonathan Ferro's off. Romain Bostic in. And what an interesting moment yesterday. I mean, I think all three of us, Lisa, came into this Fed meeting and were like, yeah. Boom.
Yeah, they surprised. And one thing that I'm wondering if we get more color on is what kind of disagreement there is in the Federal Reserve, because you did have members increase their expectations for a Fed rate hike as soon as 2023, and two at that. And then Fed Chair Jay Powell came out, had a very different tone. How much does this represent division on the Federal Reserve?
In Equity Focus in this hour, Romain Bostic, down we went, and Powell brought us back from the market. Ben Laidler with a great note at eToro emphasizing the new volatility and the resiliency of the market. Romain, what is the resiliency of the market?
Well, I think you saw it kind of that bid come back in late into the session yesterday here. The general idea here is that, yes, the Fed is going to start to remove some accommodation, but it's going to be a while before it even starts to actually remove it. That seemed to be the message here that the markets took. But, of course, that's still going to lead to some repositioning, Tom, and we've talked with a lot of folks here that's going to lead to some volatility.
I mean, Lisa, it is the pendulum of resiliency. I mean, I guess that's where we are. And I think what it comes down to, Lisa, is people adapt. That's what we're going to do.
And the fact that this is an international market affected by central bank policy around the world.
Norway.
And it's
Norway moments ago.
Exactly. And the idea here is, yes, yields can go higher in the U.S., but at a certain point, people from Norway, people from Europe are going to come in and they're going to buy.
Lisa, the literature this morning, the real yield goes from negative 0.90 to 0.77. Is the literature just an assumption of a real yield less less negative?
Yes, less negative. However, the scale and frankly the speed in which it reverts back to something that feels more normal is hard to know because frankly, the Fed has moved their dots before and not acted on it, Tom.
And the Fed meeting yesterday, Roman Bostic on the currency watch as well. I mean, Roman, we got a stronger dollar. Sarah Vellis over at Deutsche Bank makes real clear they skewed a stronger dollar. And it's a new range. I mean, to be honest, on a data check, Roman, we're looking at new numbers in FX.
Yeah, this is a big deal, of course. I mean, obviously, the Dixie and the BB Dixie both up about a half a percentage point.
What?
Yeah, you heard me right, Tom.
BB
we're going
Dixie?
there. Yeah, or pretty early. Yes, your boss owns that one. And so let me just real quickly here, Tom, though. You take a look at euro dollar, you take a look at what happened to the peso, and you talk about the divergence between central banks. This is going to be a big story going forward if the Fed is a little bit more out of sync with what the ECB is doing and with what some of the other central banks are doing. Dollar strength, Tom. BB Dixie.
And what was so important yesterday, folks, was the separation of Mexican peso. We really didn't have the time to bring it up in the Fed discussion, but wow, did the Mexican peso move weaker? And each currency pair doing its own thing. We'll dive into that through the week and into next week as well. Right now, we straggle. Moynihan's stopping by, I think, to give me a Christmas toast. Christmas. You sign up my Christmas club.
No, he doesn't do that anymore because he doesn't want your deposits. The banks have too many of them. 8 a.m. we'll get a sense of whether they are perhaps revising that view, perhaps loan demand they see picking up. That is my main question. Brian Moynihan, Bank of America chair and CEO, joining Bloomberg Television. David Weston joining us here. Again, I am interested in loan demand. This was one of the big questions. How quickly could they revive that after the incredible stimulus? Also with the yield picture and the Fed tapering, does this give them more optimism or a flatter curve give them more pessimism? 8:30 a.m. One of the most interesting U.S. initial jobless reports in a long time. The key question I have is a number of states have stopped with the enhanced unemployment benefits. How much does this push people back into the labor market? Do we start to see the ramifications from that? And will that be a positive in terms of bringing more people into the labor force? Or will it prove not to really be the root of the cause here for the gap in the number of people coming back to the labor market? And at 10 a.m., Janet Yellen continues her tour of Capitol Hill, testifying day 2. This one to the House committee to talk about the Biden budget. We heard yesterday about capital gains taxes, about how there was a plan to implement them perhaps later this year, but have them retroactive till April, Tom.
Yeah, retroactive never works out. That's my experience on that. Lisa Brun, of course, I'm in the triple leveraged all cash fund, so I guess I really don't have to worry about capital gains or anything like that.
Or even gains.
We've got some great conversations on radio and TV this morning, and we start with a gentleman with a very short note. John Golub writes 2- and 3-page notes that are massively sector-dependent and data-dependent, and we're thrilled that he joins us this morning in his optimism. John Golub, I like what you say about high sales growth companies. It's a struggle. It's a yin-yang kind of thing there. Tell me about the substantial further progress of high sales growth companies.
Well, what we've seen is that the market has been a value-driven market and growth has lagged. But if you look at kind of growth on steroids, these are companies with higher sales growth, not just higher earnings growth. They're really doing quite poorly and they remain expensive. So think about some of these more speculative companies. We think that they're going to lag in the current environment. Right. And we continue to believe that even with the Fed saying what they did yesterday, that the value cyclical trade is going to work and the market's going to be strong.
And what's great here on radio, you can't see it, but Golub, forget about having the fancy bookcase behind you. Lisa, Golub's got Henry Kissinger's magisterial world order behind him. That was my book of the year a million years ago with 2 really prescient chapters on America, still true today.
So what's the world order going forward if you're going to have that tome behind your head? When it comes to a potential hawkish Fed, does it kill off some of the transformation that we've seen in equity markets, like increase in meme trading, like the increase in SPAC issuance?
Well, Lisa, let's put this in perspective. We know there's inflation everywhere. We had a 5% inflation print on CPI, a 6+% inflation print on PPI, and the Fed was acknowledging it. And they said, okay, we may have to raise rates in 2 years from now. At the end of 23, expectations of 60 basis points in a market or an economy that is on fire. If they didn't acknowledge what we're all seeing, I think they would have lost credibility. So, yeah, they took a little bit of our candy away. We were incrementally unhappy. We're 1% off of all-time highs. But I don't think that we're really changing this. This is still zero money. And unfortunately, I think that some of the speculative trades are going to continue to work because it is still a very accommodative environment.
All right, we'll go from the speculative to, I guess, the more stable companies here, John. When we talk about valuations in this market, there was an argument being made last year and into this year here that a lot of the highest valuations were actually assigned to some of the highest growth companies, at least on a revenue basis here. Is that still the case going forward?
It is. And that was actually the point of that note that Tom was mentioning, is that the market's expensive, but it's not the average company that's out of whack. It's really the stuff at the very top from a valuation perspective. And a lot of these things are very speculative in nature. Those stocks we think are going to be vulnerable, and which is probably a good thing for investors who do the fundamental work and focus on the underlying earnings and cash flows and all that boring stuff.
John Golub, John from Coventry emails in. He says, would you guys stop talking and ask him what SPX is going to do? What's your Standard & Poor's target out 1 year?
So we have the highest target according to the Bloomberg survey at 4,600. Wow. That's a little bit less than 10%. That's pretty bullish. We think that earnings are going to be about 200. Wow. Which, that's a big, that's a big number, but companies are beating really, really strongly our topping out.
This is great, John. Send in more questions, Lisa.
Jonathan, there's a question of how far we can project this into the future. Are we still bringing the returns of the future to the present, or is this something that's sustainable with 10% returns foreseeable for a number of years out for the S&P?
I think that was one of the challenges with the Fed report, that you were seeing a more of a dispersion of what the Fed governors were saying, because there's just so many unknowns on how this reopening is going to do. The real question is, when do we get to normal? Because then you would expect, your typical 8% return. I don't think we're going to get to normal from an equity perspective until the early to mid part of 2023. At that point in time, the Fed's probably already moved. At that point in time, GDP is already growing at 2%, back in line with normal history. Between now and then, I think stocks continue to be on fire and value continues to win.
John Golub, you've been killing it. Look at 12 months trailing market returns, folks, to know that John Golub at Credit Suisse has just absolutely nailed it there with a bold call out to 4,600 SPX. I'll triangulate and find out what that means for the Dow Jones Industrial Average on the break. This is a really, really important headline, and it has global and indeed American ramifications. The basket child of G7 Europe is Italy, and whatever you say, Draghi has resurrected it. Lisa, this is extraordinary. I don't even know what a 5% Italy means for Draghi and what it means compared to 8, 9, 10% U.S. That's a stunning statistic.
What we're talking about here is that Italy is said to see economic growth well above 5% this year. This is faster than the latest projections from the central bank. And what I find interesting, Tom, is that this comes in tandem with Banco Santander over in Spain, saying that the growth is probably above 8 or 9%, well above the Bank of Spain's 6.2% estimate. The surprises are to the upside, Tom.
Remain in U.S. dollars. I got an Italian stock market 12 months trailing up 39%.
Yeah, and look, I mean, to Lisa's point too here, there is sort of a rising tide going around Europe right now. A lot of that, of course, you have to credit to the ECB, and well, I guess circling back, you have to credit that to Draghi and some of the measures that he put in place before he left. Yeah, Lisa.
Well, but how much of this is that this is a mystery, as Jay Powell said? This is unprecedented. We couldn't understand the depth of the downturn, and we don't understand the rapid speed of the recovery.
I'm going to say you're both right. I think this is a discussion that we're not going to do in 15 seconds, but there is a mystery to this, but it's a lot of courage to move policy forward, and the now what of it maybe will keep us employed. I think we'll get through the 4th of July.
Lisa's not done arguing.
Is this transitory chummy?
No, this is not. We're making substantial further progress to being on speaking
in our friendship.
We're making substantial further. It'll all go away when Ferro gets back. This is Bloomberg. Good morning.
With the First Word News, I'm Ritika Gupta. For months, Fed officials have said that price increases are temporary. Now, they don't seem so sure. Policymakers have signaled they expected to make 2 increases to interest rates in 2023. That surprised financial markets. Fed Chair Jerome Powell said there is a risk that inflation will be higher than the central bank thinks. Prospects for a bipartisan deal on U.S. infrastructure are improving. 20 senators, including 11 Republicans, have signed onto the framework for a $579 billion package. That's the biggest in decades, although it's a lot less than what President Biden wants. It also includes a plan to index the gasoline tax to inflation, which the White House opposes. Both Joe Biden and Vladimir Putin are claiming victory in the Geneva summit. Putin got legitimacy on the international stage, and the U.S. president argued that he confronted Putin over cyber attacks, Russia's treatment of democracy activists, and the need to cooperate over nuclear weapons. Hong Kong has approved a plan to ease the city's strict travel quarantine. Bloomberg's learned the city will shorten the hotel quarantine for fully vaccinated travelers from most places to 7 days, as long as they pass an antibody test. Hong Kong's powerful financial industry has criticized its quarantine policy for being amongst the world's toughest. Volkswagen is gearing up to make and sell a lot more electric vehicles in North America after the Biden administration unveiled a plan to speed up the move towards electric cars. VW's brand development chief says the car maker will realign manufacturing. The company plans to launch about 70 battery-powered models by the end of the decade. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I made it clear to President Putin that we'll continue to raise issues of fundamental human rights, because that's what we are. That's who we are. The idea is we hold these truths self-evident, that all men and women, we haven't lived up to it completely, but we've always widened the arc of commitment and included more and more people.
President Biden, at an extraordinary press conference yesterday, I want to stop the show, and for all of you on radio and TV, the moment yesterday, which passed all understanding, was with David Sanger of the New York Times was asking a blistering question on a blistering hot day in Geneva, and the President of the United States said, "With your permission, I'd like to take off my coat." Wendy Benjaminson joins us now from Bloomberg in Washington. Wendy, that stopped me in my tracks. Here's the president, literally out of the past in Ronald Reagan, so comfortable, he just decided, I'm going to take off my coat in the middle of a David Sanger question. This is a throwback to another era, isn't it?
Well, yes, it is. I guess it is a throwback to another era. George W. Bush was also famous for, stripping in the middle of a news conference. But yeah, I guess it's hot, you have to ask a question. President Biden's a little more comfortable around the press perhaps than his predecessor was.
I think we underplayed, Wendy, yesterday, the young Joe Biden's efforts on Russia and arms control. Did we sell enough in the media his familiarity in dealing with the Soviet Union and with Russia in the past?
I don't know whether we sold it enough, but yes, President Biden has a very, very, very long history of dealing with Russia and the Soviet Union in the Senate. He was on foreign relations. He's very familiar with these nuclear treaties, and he and Putin could probably talk in some detail if Putin is as familiar with them as we think he might be. They could probably talk, without a lot of help from aides, on the resumption of talks about the nuclear reduction treaty that they agreed to yesterday.
And now, as President Biden returns to the White House to sort of have a coda for his European tour, was it successful?
I think it probably came off as quite successful. He had this good talk with Vladimir Putin. where he can claim that he was very tough to him and he told him to stop cyber attacks and he told him to release human rights, prisoners over human rights issues and all of that. At the G7, he was welcomed very warmly after years of tension between Europe and President Trump. And so, I think he comes back with a success, and he comes back to some possibly good news on the infrastructure bill. So, I think he had a good week.
The good news on the infrastructure bill, what does it mean in terms of timing and scale, headline numbers for this potential bill?
Well, what they've got right now is 11 Republican senators, which is key. They needed 10 Republican senators to sign on to a potential infrastructure deal that is about half the spending, maybe a third of the spending that Biden originally wanted. But if he can pass this and score points on a bipartisan effort on classic infrastructure, roads, bridges, all of that, then they can move to reconciliation and pass a Democrats-only bill on all of his other priorities, the CARES economy and things like that. And that could make the left wing of the Democratic Party happy because they're not going to be happy with this bill. The one holdup is this indexing the gas tax to inflation, which Biden considers regressive.
What's the next step here, then, Wendy? If he does manage to get over this hump here, what becomes the agenda as we get deeper into the year?
Well, I think it's that second bill. If they can pass this classic infrastructure bill, then that's a big win actually for both sides, because both sides can say, we got you what we wanted, and the Republicans can say we did it without all these, quote unquote socialist add-ons, and the Democrats can say they can prove they can work with the other side and get something done. So then the next step is to get the rest of Biden's economic plan, which was trillions of dollars, and that they're going to have to do with only Democratic votes.
Well, right, and
got to get that done before the midterms.
Yeah, well, absolutely. We'll speak to that here because it seems like the rest of that agenda, I guess, to use a derisive term, I guess, would be considered to be part of that socialist agenda by some of his foes there. I am curious as to whether he has enough political capital, or he will have enough political capital left to actually get that stuff through.
Well, the key is to keep the left happy, right? I mean,
good luck.
Those votes he will then need, because if he got the Joe Manchins, the Kristen Sinemas on board for the classic infrastructure bill, he's got to keep them and placate the left wing of the party who could decide to not go along with some of these things, although these are their priorities, the things in the CARES economy, helping working families, adding to child care, adding to health care and things like that. Those are their priorities. And so if he can make everybody happy before the midterm voting starts, then he's in a really good place. But that's not pretty high. It's a pretty hard task.
Wendy, thank you so much. Wendy Benjaminson with us from Bloomberg here as the president lands. We show the footage before of the landing at Andrews in the dark of night as well. Lisa, we are scrupulous about corrections. Al emails in, and thank you, Al, so much for watching the show. He may be listening on radio, I'm not sure. And he says a major faux pas there. I was looking at the press conference as Reagan and Biden. Of course, Wendy correctly mentions the younger George Bush. Al corrects me and says that we need to look at all the press conferences of the president, and he centers out on President Reagan, President Biden, and President Josiah Bartlett as well. So we thank you so much for that, Al, for moving the dialogue forward here. I give up.
Actually, I'll be honest, it's telling that we're comparing Joe Biden to a character in West Wing. The idea here that we are looking at a very different drama than under President Trump. We are looking at a more traditional drama fitting into the schools of presidents of yore. And frankly, that was the message and the takeaway from the G7 and G20.
I think maybe Al will email in further on saying that we're getting a political opinion from Abramowicz there on the drama of the Trump years.
All right.
I think we got to be careful.
Yeah, I'm going to be careful here. And I guess, Tom, I'll give you your Dow update here. 33,865 right now on Dow futures, Tom.
But we really haven't broken down. Seriously, okay, we're seguing here.
No, I'm sorry. I'm not going to say that I was giving a political opinion. Joe Biden is more traditional than President Trump was in terms of international relations. And that was the big takeaway from the tour overseas. That's just fact. And frankly, that was a whole that was actually what President Trump said he wanted to do, was to root out deep state.
I'm raising my hand here
Please,
for
go
a second.
ahead.
Here, Lisa, no, it's a great point. I mean, to Lisa's point here, and you saw that reflected in some of the commentary out of the European leaders, of course, when he was before he even got to the Putin meeting, obviously with NATO and the G7 meetings as well. This idea here that it is a little bit more predictable. It is cut from the cloth of traditional diplomacy, and I think a lot of world leaders wanted to see that. At least they wanted a little bit of relief after 4 years of, I guess, a different direction.
Lisa, are you done, or do you want to have a final thought here?
I'm never done, Tom, but I'll let you go. Carry on. I could always say more, but I'll let you carry on.
Okay, thank you, Lisa. It's nice of you. I want to get back to the markets, and my question to Romaine, which we did not answer, was did we break any kind of support yesterday on the equity market? I would suggest we not. We'll learn that from Romaine Bostic here and some of our good guests in a moment. Brian Moynihan at 8 a.m. with David Weston. Good morning on radio and television. Bloomberg surveillance on radio and television. We say good morning to you. Claims, we've forgotten about it, 1 hour away. Lisa's right, it's a big number today. Claims. We will also claim the high ground on conversations on banking. Brian Moynihan of the Bank of America in conversation with our David Weston. Looking forward to that near the top of the 8 o'clock hour. Trading weakness, trading tepidness. Lisa, help me here. Trading sogginess reported by other banks.
A return to the normal, and not necessarily the boom that we saw.
What are you, PR for Bank of America?
No, I mean, honestly, I'm not trying. Oh my God, you're just trying to tweak me, aren't you?
Got that right. Moynihan at 8 o'clock today. Before we were rudely interrupted by the improper Lisa Abramowicz, Romaine, I was asking you about technical support in the equity market. We did not breach technical support yesterday, did we?
No, not on the equity market. I mean, we stayed above all of the key moving averages, short-term, long-term. Keep in mind that support level, at least on the S&P 500, Tom, that's right around 4,200. We basically hit that yesterday, bounced off it. We should point out that main resistance level, though, we also hit that and bounced back down off of it. That's right around 4,250. So keep an eye on those two levels. As far as what's going on with some of the individual stocks here, maybe we could take a look at those. Not sure what's on the board behind me. Oh, we're going to start off with CureVac here.
Make it up as you
I've
go.
taken a cue. I just make it up. Down 46% here in the pre-market. That company's COVID treatment that it's been working on, only 47% efficacy. This is their vaccine here. That's not what the street wanted to hear. Those shares really under pressure here. Also keep an eye here on what's going on with Citigroup. The shares rebounding a little bit today, up about 0.5%. But keep in mind, they dropped 3% yesterday, and they're actually down more than 10% over the past 10 days. In fact, they were on a 10-day losing streak here. So we'll see if these pre-market gains hold. If they don't, they're now headed for what could be their longest losing streak since mid-2018 here. Newmont Mining, when we talked yesterday about the reaction to that Fed report, one of the biggest and most severe reactions was what we saw in gold prices. Gold dropped about 2.5%, at least spot prices did. The gold price is also down here as we head into the pre-market of equity sessions here. That's weighing on Newmont, Kinross, Barrick Gold, all of the gold and mining stocks here. Flip up the board real quickly. Let's get to a couple of other movies. We did get some earnings out of Lennar, the home builder. They were fantastic. Purchase contracts up more than 30%. Gross margins also improving here, up around 26-point-something%. Adobe going to report earnings after the bell. Expectations high there. We've seen a nice little pop in this stock over the past few days. Those shares down in the pre-market, though. And finally, keep an eye on Sunrun, the solar power maker, up for a second day here, at least based on pre-market pricing, up 6%, Tom. Some relatively bullish sell-side commentary.
Romaine, pro tip, if Moynihan's coming out at 8 o'clock, you somehow get Bank of America into the data check. Bank of America, 41 7/8, up 3/4 this morning.
Thanks, Tom.
See how I did that with fractions, Romaine?
Yeah, you're a pro.
Real throw. Well, I don't know if I'm a pro. It's a throwback.
Are you doing PR for the bank ahead of the interview?
Yeah, I'm doing. Thank you. Well said, Lisa.
Anytime.
Return of service there. Right now on foreign exchange to save us this morning, Mark McCormick joins us from TD Securities, and this is important because sometimes you need to be courageous, and young McCormick was way courageous. Everybody else was talking weak dollar, and he was sort of maybe, but maybe not. He joins us now from TD Securities this morning. Mark, everybody's swinging strong dollar. Do you reaffirm strong dollar?
I would put it in the camp is tactically you have to think about consolidation and stability. So I'd say through the summer months, our view has been we're looking for a more stable dollar. I think what we're actually seeing, this pattern looks very similar to what we saw at the start of the first quarter, which was the market was extremely bearish. The dollar positioning had validated. Yeah. We're starting to see some stalling in the global reflation trade, and now the Fed has turned a bit more hawkish, or at least what we're calling the second derivative of taper talking is moving in the right direction, which is basically all signs pointing towards, again, what could be another 2% move higher in the dollar through the summer months, recreating about the 3.5% move we saw in the first quarter.
You're killing me, Mark. I mean, you see how he does that, folks? He tries to get a lot of fancy calculus talk in here.
I was thinking the same thing.
He's talking about the gamma of taper talk. I mean, he goes in the Bloomberg timeout chair for that. Mark McCormick, what I notice here is different currency pairs are reacting very differently. Romaine Bostic featured dollar peso. If there's an opportunity in individual pairs, given a new Fed, which is the pair that I can profit from?
Well, I think, again, it depends on the context of the baskets. Like the thing that's driving currencies, carry, relative growth, equity momentum, terms of trade related to commodities, and valuation. So those things are very critical in kind of thinking about it. Eurodollar is obviously the key here in G10 because, again, the ECB is now kind of the most dovish central bank in the G10, probably the most dovish central bank in the world. So there's an element here that now euro is going to crack through 120. It's probably going to retest 117.15, 118. I think on the EM side, we have a little bit of a different story. There's been front loading of EM central bank tightening through March, April, May, which has really been a reason why the dollar's weakened. So against some of those major EM currencies. Brazil is one that could probably do relatively well. We just saw the BCB hike 75 basis points yesterday, and they're basically going to tighten more. I'd say your biggest concerns here are probably something like Hungary, Eastern Europe, Poland. South Africa is another one. And again, Turkey is really not related entirely to the U.S. story, but Turkey's got its own vulnerabilities. So there's an element here where central banks and EM that are tightening and have links to the commodity cycle and have relatively good growth can be insulated. But again, it's mostly a G10 low-yielding story.
Romaine and Lisa, did you see there how I asked him for one pair and he gave me 14 pairs?
That's how you do it.
That's how you do it.
That's how, and frankly, that's how you do it with Mrs. Keene when she asks, can I have one pair of shoes? And you bring home 14. Just saying. I will say, though, Mark, there's a question going forward of what the pain trade is. We have seen the pain trade with the dollar over and over again. I'm imagining people piling into long dollar and then all of a sudden getting their faces ripped off in Wall Street parlance when the Fed doesn't follow through on some of those more hawkish projections in the dots. What's your view on whether we're just setting up for another pain trade?
Yeah, that's a great question, too, because a lot of it is this a positioning or is this something new? Is like the Fed, is this a game changer for the Fed? I think it does. It fits into the positioning camp, but everything is aligned together. So if you have a view on the dollar for the next 3 months, you would expect more rates volatility. You expect lower break evens. You expect higher real rates. You expect nominal rates to drive the move, which is what we saw yesterday. So there's an element here that it has to be slightly risk off. It doesn't have to be a huge game changer, but we're injecting more two-way risks, a stronger dollar, and behind the scenes there, we're going to see probably a little bit more disruption in the reflation in the equity story. Because there's an element here because the markets have been kind of focused on global reflation, U.S. exceptionalism, and we kind of keep going back and forth on the pendulums. And I think what we get is a little bit more exceptionalism, the Fed catching up to other people, and less global reflation because our high-frequency data that we're tracking on data surprises and global mobility have actually started to stall coming into the summer. So you might actually see data surprises outside the U.S. weakening, which is, again, another sign that might elevate the dollar. But it's, again, this is not the change for a bullish stance on the dollar, but it's a pause in what we saw over the last couple of months again, which is, again, exactly the pattern for what we saw in Q1 this year.
Mark, I'm channeling Tom Keene. I've been working with him long enough that he's in my head, and you say pendulum of exceptionalism, and there we go. That's where we're heading. And there's a question of whether people will view strengthening dollar as disruption in the rest of the world. Exactly what you're saying, actually, as a really bearish sign on a recovery that will eventually start to stall out.
Well, yeah, it absolutely needs to be a link where the sequence is the dollar's rising because real rates are rising. And that's really the plumbing of the global financial system. On a lot of the frameworks that we look at, real rates should be higher, break even should be lower. And with that, you would get more rates volatility, you'd get higher VIX. And that in itself is disruptive because what's kind of anchored everything is really the suppressed level of real interest rates. So even if we see a 15, 20 basis point move in real rates, which is kind of, again, what we saw earlier in the year, that in itself is disruptive for positions and for some of the allocations where everyone's kind of very pro-reflation, very long equities, long credit, short the dollar, long carry. That will be disrupted if real rates move higher, and a stronger dollar is basically a consequence of the change in those market dynamics, which no one's positioned for right now.
Yeah, and then what I extrapolate from what you just said there, Mark, is there's a lot of vulnerability, or there has to be some vulnerability here with a lot of the EM currencies, particularly over there in Asia. And I'm wondering that once we actually start to get a little bit more clarity, we get to Jackson Hole, we get to maybe a little bit more clarity about that taper here, should we start, I guess, preparing ourselves for further weakness there?
Well, I think that would be the time when things start to look a little bit more normal, I guess. So what we're doing is we're advancing and progressing the taper talk. So we know that the Fed is now kind of give us a timeline, which is now highly data dependent. So we're going to see more volatility on data as well, which we haven't seen for a little while. So as we get into the Jackson Hole, and what we're looking for is kind of a taper announcement coming through December. So with that, what will matter is when do we get the first rate hike, which our expectations, again, aren't really for until December 2023. So if we have a window of, taper happens here and then we don't get a rate hike for a long period of time, the markets can move back into the reflation. The dollar can weaken again. You could see a value in EM currencies, especially on the carry side, because the central banks outside the U.S. are much more hawkish besides the BOJ and the ECB. Everyone else is already way more hawkish than the Fed. So I actually think once we get through this taper process window, we kind of shift back to the reflation pendulum.
And this is really important, folks. Mark McCormick, thank you so much. Greatly appreciate that. TD Securities. And, folks, that was a real window into the pro-dynamics of foreign exchange and what they express worldwide. We're making calculus jokes at the beginning, but, Lisa, to pick it up from Chairman Powell, that was substantial further gamma is really what McCormick's looking for.
Well, in fairness to calculus, and I will say my father is a mathematician, so I'm going to really be yes, it does. I'm going to be the defender of calculus and the gamma of substantial further progress. You have this idea of the Fed potentially acting in a hawkish manner, and then people have to think not about the recovery, but about it being curtailed by the Fed's actions. These are derivative actions on top of one another, and people are trying to game this out, and then there's the reaction function to the Fed to disrupt in markets that could bring us right back where we are, which is dovishness.
Gamma, folks, to describe it, because we are jargon-free, is a second derivative in the movement, given an acceleration tendency. Romaine, is gamma good for the equity market, or is the equity market like quiet?
I don't know. That's a tough question, Tom. I mean, it's good for certain pockets, and we've seen actually people sort of make it. Look, I'm not sure where this conversation is going. All I know is Lisa right now is defending calculus. Tom right now is defending gamma, and I'm not sure where this goes in between.
What do you defend? Meme stocks?
I don't know. Naps. How about that?
I think what's really important here, you guys don't understand this, but Tottenham is talking about signing Gamma.
Wow, we've got a lot to say on that one.
In the midfield. Gareth's gone and Gamma's
Where's Ferro? Bring John
I just missed Ferro. What can I say? Gareth is gone. Gamma's coming in. Enough. Brian Moynihan in 20 minutes.
With the First Word News, I'm Ruchika Gupta. Officials at the Fed now signal that they may raise interest rates from near zero faster than they had forecast. Policymakers expect there will be 2 rate hikes by the end of 2023. Fed Chair Jerome Powell acknowledged there is a lot of uncertainty. Powell said there is a risk that inflation will be higher than the central bank thinks. Congress has given final approval to a new federal holiday celebrating the end of slavery. Juneteenth, or June.19, will be the 12th federal holiday. It marks the day in 1865 when Union soldiers brought word of freedom to enslaved people in Galveston, Texas. President Biden will sign the bill into law today. And it's a milestone for China's space program. A Chinese spaceship carrying 3 astronauts docked with the country's new space station today. The crew will live aboard the space station for 3 months. They'll carry out experiments, test equipment, and conduct maintenance. Police in Hong Kong have arrested the 3 top editors at the pro-democracy Apple Daily newspaper. Two of the paper's executives also were arrested. They're accused of breaches of the sweeping national security law. The paper's founder, Jimmy Lai, is already in prison for attending unauthorized protests. And CureVac has lost more than half its value after a preliminary analysis of a study found its COVID-19 vaccine fell short of the efficacy bar that's been set by similar shots. The drug maker says its vaccine was only 47% effective. The findings throw the vaccine's future into question as nations buy up shots that are already available. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I think the risk is that they're going to be too slow because they basically said that they're not even going to start to tighten monetary policy until there's three conditions met: 2% inflation, they're at full employment, and they're confident inflation is going to move above 2%. That's a pretty late in the game to be starting to raise short-term interest rates.
William Dudley, writing for Bloomberg Opinion of the New York Fed, and of course one of the true founders of modern Goldman Sachs economics. A joy to have Jan Hatzius join us in studio yesterday. And really the hallmark of Hatzius' conversation was a view to under 3% GDP out there somewhere. Stocks and bonds will react to a Goldman Sachs sub 3% GDP at some point. Out front and expecting forward is our David Wilson, our Bloomberg Stocks editor. This is on the linkage at the hip of bonds and equities. What's normal?
Well, normal, if you look at the last 20 years, is that they tended to move in opposite directions. Now, we're talking price here when it comes to stocks as well as bonds.
Not
Correct.
yield. Okay,
Correct.
Okay, we got to get that. For radio, we got to get the hands out. Stock price up, bond price
up, and therefore bond yield down.
Got it. Continue.
Exactly. That's the key.
Yes.
So, for basically the last 20 years, you have seen stocks and bonds move in opposite directions. So if you own both for the sake of diversification, you've got what you wanted. Lately, though, it's been a very different story. And the chart focuses on a 90-day correlation between S&P 500 futures and 10-year Treasury futures. And in fact, that has turned positive. So you've got readings of about 0.4 at this point, and those are the highest since November 1999. So, if you go back to the 80s and the 90s, which the chart does, you can see that stocks and bonds did tend to move together then. It's just in the last 20 years, it's been the opposite. Yeah. So now we're kind of reverting back to the past.
Right. David, Lisa's been on fire this morning. Let's have her beat you up as well as us.
Trying to set me up for failure, Dave. I'm looking at this and I'm wondering what this says about the 60-40 portfolio. I mean, to me, this chart speaks to the pain underlying a shift here as people don't look at bonds as a hedge against their stocks anymore.
Right. I mean, what happens to the 60-40 portfolio? I mean, it's great if both are moving together, but if they're, and moving up. But take a day like yesterday, take the past week, they were moving down together. So, it's like the losses get compounded for investors who were in both types of assets. And that's not something they're used to, given the past relationship. There's the past week. I mean, you've seen stocks and bonds move down just as they did yesterday. So, and in fact, the correlation between stocks and treasuries in terms of price, when you look at other asset classes, is relatively high, or at least has been lately.
Yeah, but we've seen these go back and forth here, Dave, and I understand that right now, when you look at that correlation chart, it kind of gives you a little bit of chill here. But when we talk about how people are allocating, the idea that some folks, of course, have now embraced corporate bonds, some people have embraced alternative assets, and some have embraced the real speculative assets like crypto here, Dave. Is the exposure, I guess, the same historically today than it was historically?
Well, the exposure may be a bit different, but when you think about relationships, you tend to see people talking a lot about interest rates in the context of technology companies, simply because, you're talking about the type of assets that may be especially hurt as interest rates go up. So, there is something, that kind of carries through, even though we have changes in the asset mix these days.
David Wilson, thank you so much. I want to turn right now, folks, to who is Brian Moynihan. I don't think he's had nearly enough press on this. Lisa and Romaine, it's real simple. Long ago and far away, there was Fleet Bank, there was Bank of Boston, there was this merger, that merger, the other merger, and all of a sudden they were merged into the Bank of America. I'm guessing here 2004 and on to 2009 as well. And what is extraordinary here, Romaine Bostick, is the cards that Brian Moynihan was dealt. There has never been enough discussion of what he was given when he took over leadership of the bank.
Yeah, I mean, a lot of people sort of forget, just the shape that Bank of America was in, not only in terms of the finances, but also in terms of reputation here, too. Right. It was really quite a turnaround that he's made here. And it's funny you bring that up because there are a lot of people that are now compare to some of the challenges going on right now with Charlie Scharf and Wells Fargo. They sort of compare this to what Brian Moynihan had to take on. And, of course, now the sheen is really all over Bank of America right now. And Brian, who I believe is going to be on this program a little bit later.
It's going to be on in 8 minutes or so, make it 9-10 minutes. And I was at a G7 meeting in Singapore with Barry Eichengreen at Berkeley, and there was Ken Lewis picking up the pieces in Asia. Lisa Abramowicz, I look at all of this, and you look at the view forward for banking, and you are dead on that any of these banks, they can, put up smoke signals, they can do this, they can do that, but it is a traditional banking that right now is flat on its back.
Which is the reason why people are so concerned about a decline in trading revenues, because that was one of the mainstays of recent earnings reports. The idea here, if you don't have that pillar, will the lending portfolio start to pick up to compensate? There was a story in the Journal I thought was interesting. Banks to companies, banks to, no more deposits, please. Basically charging companies for deposits, saying, we don't want your money because we got too much cash.
Yeah, I mean, we've seen that. I actually looked at the overnight repo chart, the IRA Jersey chart today, and it's legged back up again to cash up to our eyeballs as well. We say good morning on radio. Please stay with us in Boston, 106.1 FM in Boston for this conversation with a rugby player from Brown University. How are the banks doing, Romaine? Forget about Bank of America.
Yeah.
Fortress Moynihan will be on. How are the banks in general doing off the Powell presser?
Well, they were doing pretty well yesterday. Of course, we saw a pretty big rally in all the names with the exception of Citigroup and I believe Huntington. But you talk about the big money center banks, whether you're talking about Bank of America, you're talking about the traditional Wall Street banks, or you're talking about some of the regional banks, they benefit from an environment where you start to get a little bit more rate normalization, particularly, Tom, if that rate normalization also is at a time where the economy is still solid. That's the key.
We rip up the script here. Lisa, I'm hitting you over the head with this. I know you haven't seen it. Stefania Spazzotti writing in London for us. JP Morgan buys digital wealth firm Nutmeg for United Kingdom retail launch.
Wow.
Actually,
that's really an interesting story.
That is really interesting, and having not read anything about it, I will just tell you it really speaks to this desire to try to acquire fintech, and particularly to do that within the consumer banking sector, especially as people transform into that kind of platform post-pandemic.
So you say to Moynihan, what are you doing in France, right?
Exactly. What do you do with all that money? Are you going to acquire some sort of fintech operation? How are you going to build up your technological efforts?
Oh, there we are. And it's very interesting. Stefania, thank you so much for that article on JP Morgan and their United Kingdom retail launch as well. Nutmeg. I have no idea what nutmeg is, and actually nutmeg in a rum punch.
I was going to say. I was wondering which alcoholic beverage of your choice you were going to choose. It definitely is a good ingredient, though.
It's in Jamaica and it's down the shore. You go around the bay and there's nutmeg floating.
Right. Well, we know what Tom's doing at, about 10 a.m.?
God, no,
Can I join you?
Come on, Romaine. No, be nice, Romaine. You sound like Lisa. 12:10 p.m. Futures -11, down futures -73. Coming up in minutes, Mr. Moynihan with Mr. Weston. That is a good and beautiful thing. Good morning.
There's just so many unknowns on how this reopening is going to do. The real question is, when do we get to normal?
It's an economy that's starting to move from recovery into an expansion phase.
Could we have several years of much higher inflation? Yes.
In the end, I think the Fed is committed to the mandate, and the mandate obviously looks somewhat different now.
Danger is upon us, really, in a sense. And that behooves action, and I think the Fed did the minimum.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Embracing claims Thursday with a humble Fed framework. Good morning. This is Bloomberg Surveillance on Bloomberg Radio, Bloomberg Television. Tom Keene, Jonathan Ferro, Lisa Abramowicz, John out, Romaine Bostic, very much in. We've had a shocking Fed meeting where they actually did something. I mean, it was shocking in that it was not a snoozer, to quote you, Tom. There is a question, though, of whether we are looking at a new framework where inflation, perhaps, Tom, is more important than full employment, whatever that may have meant to the Fed 3 months ago.
That's clearly what we're hearing in all the research reports we're taking in at surveillance. Lisa, what I would do is get out the date calendar. Yes, July 28 matters, but can you imagine the dialogue, Lisa, given the data of September 22, November 3, and it even suggests the year-end snooze fest of December 15th will have huge value.
It won't be a snooze fest, that's for sure. We're seeing 5-year yields continuing to climb. This expectation for potentially 2 rate hikes in 2023. Romaine, the stock market has managed to shrug this off to a large extent. At what point could it be disruptive?
I think there is, if you will, a little bit of calculus that has to take place here, Lisa, where folks have to sort of adjust to some of the shifts in gamma. And potentially, I guess, the general idea here that even if the Fed has sort of shifted their general thinking, it's still going to take a while for that to actually coalesce in real policy changes.
Tom, as we set this up ahead of Brian Moynihan coming on, I have to go to the flattening yield curve. And at what point, higher yields, I guess, good for banks, flatter yield curve, bad for banks? At what point is the Fed looking at a Fed regime that is less friendly to the business model rather than one that actually allows them to profit more from their loans?
Let's rip up the script and stop the show in its tracks. You nailed it yesterday, Lisa, looking out the curve, the dynamics of 5-year out to 30-year. There's a so-called belly of the curve, which we looked at as well yesterday. And I would suggest, Lisa, the fun and games is going to be in tight. It's going to be amazing to see some of the dynamics in the measured maturities and even in the overnight wall of cash we've got out there.
Yeah, and if you look at just sort of a size and scope there, 5 to 30-year treasury yield curves are actually now the flattest of 2021, Tom.
Now, we welcome all of you across this nation on radio and television, particularly in Charlotte, and also, of course, 106.1 up in Boston as well. Futures at -12. The VIX goes out 15 out to 18.28. The yield, the 10-year yield, way different than pre-Powell, 1.57%. And that is a good introduction to the gentleman from Boston. Here is our David Weston.
Thank you so much, Tom Keene. Yes, we are joined by the chairman and CEO of Bank of America. He's Mr. Brian Moynihan. Brian, thank you so much for your time today. So the Fed has made it official, more or less. We need to pay attention to inflation. It's not clear exactly what we're doing, but we need to pay attention to it. They didn't move anything except some dots on some plots, but did they get it right? Are they reacting in the right way at the right time, or is it too much?
Well, I think first, David, good to see you again. I think there's 3 key points. The first point is about the virus, the vaccines, and the variants. The second point's about the dot plots, but what is the underlying Fed predictions of the economy? And the third point's about thinking about this Fed and where they were in 19. So first point, if you have the 3 Vs, virus, variants, and vaccines, you really have to listen that they need to see the hole that they were trying to fill between fiscal stimulus and accommodation was to put the economy back to where it was and with the same growth characteristics or, frankly, even better growth characteristics. And if you look around the world, central banks are going to struggle as to when this virus is behind them because at the end of the day is the determinant here. So if you think about India, think about what they went through over the last several weeks. Think about in the UK delaying the full reopening because of the variants. That's the variant question. You think about the U.S. vaccines through half the population, you can see it's pretty open, and the question is, will the variants affect us? So pay attention to the vaccine path. The second question was the dots, as you said, dot plots, and there's great debate whether these add value at this point. When they're put in, they were put in for a different purpose. But leaving that debate aside, the question is the Fed's economic projections for this year are 7%, next year in the mid-3s. The street actually is 7%, matches the Fed this year, but next year, Bank of America Securities and our team there, it's a great team, is at 5%. And the Street's at high 4s. If you believe the Street and Bank of America are more right as we move through the year, the reality is the economy is growing much faster than it was, with much more fiscal stimulus still to be spent in the customers' accounts, much more opportunity for the economy to round out and grow. And that's something people should pay attention to, because last year, this year's rate of growth was half of what it's turned out to be, or predicted to be. So if those economic growth predictions move, those dot plots will become uninteresting because they'll have to move because things will be moving faster. And the third thing is think about 2019. Same Fed, same chairs, somewhat different people, same research department. They were sitting there mid-2019, 2% plus Fed funds rate, 2% plus 10-year Treasury rate. Economic projected forward growth was 2%. Unemployment in the 3s. Think about that where we are now. We got 3 times the growth rate projected. Next year, even 2 times the growth rate projected. A Fed unemployment rate projection in the low 3s by the end of 23, high 3s by next year, and low 4s, mid 4s this year. Those are full employment. And what was the only thing concerning them in 19 was wage growth. And you're seeing wage growth. So that'll be the interesting tug of war as this thing normalizes.
So Brian, absolutely right. We have a remarkable story in the bounce back of the economy and the growth. But what about inflation? Because they also have taken way up the Fed, their projection on the PCE deflator, 3.4%. Core is 3.0%. What are you seeing? You have your tentacles in to so many consumers as well as small businesses, more than anybody else. Are your customers feeling real pressure from price increases?
Well, the great debate is, what is temporary, what is transitory, as at SFP, as Tom was talking about this morning. These terms are used to try to signal what they think. Right now, the firm belief, I think, by the Fed is most of this is transitory. We'll see. But the question is, what about the stickier things? Wage growth becomes sticky, and you're seeing that come back. And as unemployment rates come down, and you're seeing, the pickup employment, we'll see what the new claims are this morning, but you're seeing the employment market tighten. If you ask our small business customers, last fall, their number one issue, pandemic. This spring, number one issue, getting people to work and supply chains. That's a whole different place, and that means inflation characteristics are out there to be filled. But is it temporary? Is it transitory? And there'll be a great debate about that. But I think it still comes down to what you think next year's projection for economic growth is, and what you see in wage growth leading into that as to whether the stickier parts of this will happen. Now, the reality is, in our customers' accounts, they still have 65–70% of stimulus dollars in those accounts. The average balance for people of $2,000 to $5,000 of average balance accounts are up 3 times and sitting there ready to be spent. You're seeing their spending grow at 20% year to date through the 14th of June versus 19, not 18, but not 20, but 19, meaning the normal year. 19–20% growth. That's very strong. So it's all set up that inflation could happen. That'll be the great debate. But I think we have to get further into the question of what is transitory.
So Brian, the one thing that seems clear after the Fed has spoken is that we are changing sort of the dynamic. We were on a loosening phase. We're now going to start tightening. It's not clear when or how fast we are going to start tightening. What does that do to Bank of America's business at its core? And let's start, if we could, with trading. I mean, we've heard from a couple of your rivals here that trading's down in the second quarter. Where are you in the second quarter? But could this cause volatility, the tightening, that could help your trading?
Well, let's go back to our economist projections are that the economy this quarter will be about the same size it was heading into the pandemic, which means that you're sort of restored, differently constituted, with shortages in supply, labor, unemployment not where we want, spending that's migrated from panic to sort of do it yourself, and now to go out and eat and things. Restaurant spending up dramatically, travel back to where it is. All that means the economy continues to grow. In terms of trading, there's always a seasonality between the first quarter and the second quarter, and we're no different than other people. But the reality, if you really think about it, is volatility helps a trading group. But frankly, from a Bank of America perspective, you'd rather have the economy growing at a solid rate and unemployment down, because at the end of the day, that means great for the core business. That means great for the capital markets formation activity, less emergency and more normalized, and also it means great for loan demand. And loan demand we're seeing start to pick up slowly as we move through the months of April, May, and June, which is better than it was obviously last fall or coming into the early spring.
So Brian, if I understood you correctly, it sounded like you're sort of along with your rivals there on trading the second quarter, which should come down. Am I understanding that correctly?
if the market moves, we all maintain our market share. It kind of moves together. So there's nuances that we'll get into, but when we get to the earnings and figure out what happens the last few weeks here. But we're not going to be a heck of a lot different from other people.
So that raises the question of, okay, what does it do to the rest of your business, particularly if we're into a tightening phase? As I say, don't know how long it'll take. Tightening phase. What does that do to things like net interest margin?
Well, the net interest margin, the deposit balances are huge, and that's due to the amount of fiscal stimulus that went in the system and the amount of monetary accommodation. So the deposit balances are high. The good thing about the business is half our money comes from the spread, deposits and loans, and you're starting to see those loans stabilize as we came through the first quarter and start to grow this quarter at a modest pace. But our credit card balances, fell from $90 billion to $70-odd billion, and those are the kinds of things that indicate the customer is still getting back in the game. Our middle market draw rate on lines went from the 40s to the low 30s. That's lower than we've ever seen it. It's stabilized there and starting to move out. So I think we're in what I call the twist of both rates and economy, that you're seeing economy normalized and rates move up. Rates moving up helps our business, but if they're moving up the wrong reason, it doesn't help our business. So the good thing for Bank of America is when the U.S. economy and the world economies are growing on a fundamental basis as we look forward.
Rates are moving up, but let's be frank, it's pretty modest still as a practical matter. And let's also be honest, the Fed continues to buy those bonds, which means there's more stimulus coming into the marketplace. Is there demand for the loans? Because the problem doesn't seem to be the interest rates, it's more whether there's demand. Are you seeing demand from your customers?
We're seeing as we came through this quarter. So our small business originations in 2021 May were about 15-20% of our small business originations in 2019 May. And that's it's finally crossed over in various areas, and that's good. Now, again, it's still not where it was. We fell from $980 billion of loans down to $900 billion of loans, and it's moving up from there. But the reality is that loan growth is actually the core business. That means the core underlying economy is going well, and we expect that to continue. And if you think from the first quarter to the fourth quarter, you'll see that growth in deposits continue. You'll see that growth in loans continue, and that's good for banking generally and us in particular. But at the end of the day, we are in the part of the process where you're seeing companies need to hire, need to get goods to sell, need to get goods to manufacture, and that's because a 7% growth rate on an economy that is the size of the American economy is, unprecedented. We haven't seen that in our lifetime. So think about that underlying activity. That'll be good for Bank of America, be good for America, and that's what we got to get focused on.
Brian, give us a sense of how the pandemic might have changed your business when it comes to digital. As I understand, you've picked up a lot more digital users. Where is Bank of America right now?
Well, the three things that happened in terms of digital in the pandemic. Number one, consumer adoption continued to go, and by necessity, it rounded out. What I mean by that, we continue to grow consumer digital customers to 40.4 million active digital customers today. But what happened is the amount of sales went from 40-ish% moving up to 60-70%, and now it's settling in the high 50s, 60%. That is very good because that means there's efficiency and effectiveness of reach of the market. But the second important thing was what had happened internally. Our ability to interact with customers, our ability to relate to customers. Think about it: 4 or 5 quarters of record investment banking fees, and we couldn't go see the customers due to the pandemic restrictions. So that ability to operate differently is really important. And the third thing is it went to various businesses. So our wealth management business adoption rates went through the roof. In our commercial businesses, the Cash Pro Mobile, the numbers of users went up dramatically, and the amount of activity went up dramatically. And so you're seeing it round out through all the businesses that the adoption of digital, et cetera, usage of digital is important. And that gives us more flexibility to continue to manage expenses well in our company.
Well, talk about those expenses. Does that mean, as a practical matter, you could see your number of retail establishments go down? I think you're something like 4,300 now?
Yeah, it's been coming down for years based on customer behavior, so we'll continue to shape it. So yesterday, the day before, we opened in Kentucky for the first time in our history. So think about that. So we're opening new markets. Columbus, Cleveland, Cincinnati, Indianapolis, Minneapolis, Denver, Salt Lake City, and then now Kentucky. I'm trying to think where else we've gone. All have been open over the last 3 or 4 years while we're shaping the distribution franchise and more markets we've been in for 200 years due to the fact that the customer behavior changes. So we watch that carefully. In long term, we've had 6,000 branches, the high point, and now we're 4,300. During that time, the customer satisfaction has gone up, which means the digital and other means of operating have replaced that activity, and that's a relentless trend which we're continuing to work on.
Brian, you've talked about the bounce back in consumer spending that you're seeing, and goodness knows you have contact with a lot of consumers. You've got some of your rivals like Citi changing their credit standards on credit cards. We have JP Morgan really beefing up on marketing. Tell me about the competition over credit cards and what Bank of America is doing.
Well, we've always taken a position in our credit card business. It's about our core customers and getting a customer in the wallet and getting it used by those customers through the reward systems we have. So we have the only all-company rewards. So if you have a preferred rewards, you get rewarded for your cards and your accounts of all types, and you get lower rates on your auto loans and stuff. So preferred rewards is a holistic rewards program. So we focus on the number one thing is the great Bank of America capabilities delivered to you, and the card is part of that. And so you're seeing that card origination pick back up. It fell probably by 70%. It's back now to about 30% lower than it was, and that's good news. Now, they've got to borrow on them, and then they got to pay us for borrowing on them, which takes some time. But the reality is it's a great business, and we like it. But it's part of our core consumer business. Checking accounts, credit cards, auto loans, home loans. Be straightforward about it. Serve those customers well, and the team under Dean Athanasia does a great job with it.
Finally, Brian, I know you said that you're hoping to get most of your people back into the offices by, I think, it's mid-September you've talked about. Are you going to require them to be vaccinated? Have you decided?
Right now, we're moving people back who are vaccinated, which our team under Sherry Bronstein's leadership, our HR team, has done a fabulous job for us in terms of managing through this. Not with any playbook, but doing it because before nobody had this happen. They've done a great job. So we built a vaccine tool 3 or 4 months ago and voluntary capture. We have 70,000+ people, and we're concentrating on getting them back to work because that allows people to move about under the CDC guidelines without masks and things like that. As more people get vaccinated, we keep bringing more back. We've got a lot of work to get those back. But the view is after Labor Day, our view is all the vaccinated teammates will be back and will be able to operate fairly normally, and we'll then start to make provisions for the other teammates as we move through the fall.
Okay, Brian, thank you so very much for your time today. That's Brian Moynihan. He is the chairman and CEO of Bank of America. Tom?
David Weston, thank you so much. On radio and television, Bloomberg Surveillance, we welcome all of you across the nation. I really got a lot out of there. Romaine Bostick, to me, the basic idea is Bank of America with, all the mergers over the decades. They wander into Kentucky, and the new marketing plan is to give out a bottle of Old Forester to bring in those deposits. It works. Right?
Yeah, I'm not sure he said he's giving out Old Forester there.
I heard that.
I don't think
Hear
so.
But
I think he has done a lot of other good things there, Tom, to try to sort of lure not just depositors, but really it's a much broader business than just the depositors there. And he's done a pretty good job doing that, even without handing out bottles of whiskey.
But Lisa, what I learned there, to your point, Lisa, you've really been dead on this, is there's just a wall of money across all of our lives that we don't know what to do with.
Yeah, and he was talking about how spending is definitely picking up in a significant way. He talked about the mystery of inflation, right? Yes. What was interesting to me, though, is the idea here is that he is concerned about inflation, that he talked about the labor market constraints that clients were talking about.
Yeah,
look, but there is a question here about the health of corporate America in this strange environment that is uncharted. And,
uncharted.
Uncharted.
That is the key, is original territories we heard from Chairman Powell. Today, futures -15, Dow futures -95. Yields have made a move, and we look for more data. Kit Jukes, the Societe Generale, really making a point this morning that we've shifted to an analysis of the data. Maybe that'll carry forward through the summer as well. Right now, to reset and to move forward, James Paulson joins us now. Jim Paulson is with Luthold Whedon and has a wonderful and Midwest view of where we are right now. Jim Paulson, in what way is the broad Midwest of America different than what Chairman Powell's living on the East Coast? What is the difference you observe out there in our recovery from pandemic?
Well, I think it's fairly similar, Tom. I really do. I think that I think there's been palatable relief everywhere, and you're seeing Minneapolis here pick up pretty dramatically outstate as well as in the city, and people are taking in all the things they couldn't do for a year. Restaurants and travel, the airport's full again. So there's a boom. There's a huge boom. I was listening to the Fed's up to 7%. I still think we're going to do 8 to 9 this year, and probably like Brian Moynihan says, maybe 5 next year. So I think there's just so many forces that are at work, not only the stimulus this year, but leftover forces that's going to keep growth strong here into next year and maybe beyond.
Jim, there's a question about peak growth, and I want to go to something that Brian Moynihan said. He said that middle market customers are hesitant to draw credit lines. This speaks to the reluctance to take out new loans at a time of stimulus and, frankly, uncertainty forward. Are you concerned about peak growth and how the market will respond to that in tandem with a perhaps more hawkish Fed?
Well, I think, Lisa, that there's no doubt we're going to have peak growth in the second quarter. I mean, we're going to, we fell 9% year on year in real GDP a year ago at this time, record-setting 1 year post-war collapse, and we're going to have close to a record-setting post-war advance in a 4-quarter period this year. But when you're doing peak growth from 13 to 15% year on year, and it slows down, I'm not sure anyone's going to notice, because we're still going to be growing, close to double digits in real GDP, I think, in the balance of this year, 8 to 10% or something in that ballpark, which is still off the charts historically, I think, going forward. So I'm not sure the peak growth that people worry about in the traditional cycle is nearly as meaningful this time around. The real issue is this just a one-time sugar high in 2021 in growth, or is it sustainable growth going forward? I think it's looking more and more like sustainable real growth, and that says a lot for the stock market. One quick point on Fed tightening and inflation in general. When I look back historically, when you have the type of growth that we have, so strong and fundamental profit growth that's exploding, the impact of tightening and the impact of inflation on the stock market is far more minimized than it is when you have more normal or subpar normal growth rates. And let's face it, for the last couple decades, we've had subnormal growth in the United States and across the global economy. Yeah. And these tightenings and inflation pickups were very damaging. I'm not sure they will be as much if we continue to grow at this pace.
And you're certain, though, Jim, or at least you have confidence here, that if you remove the Fed accommodation here and maybe we get some normalization in fiscal policy, meaning we stop throwing logs on the fire here, that that sustainable growth rate, that's still there?
Well, let's talk about next year. Just look into next year. Let's leave stimulus aside, but let's look at, Brian Moynihan just said that, the unspent stimulus checks that are still out there that are going to be spent into next year. Look at the untapped, unprecedented massive savings that will bleed out, maybe not all next year, but over the next several years. Look at the increase in productivity that's happening. We've got GDP back to where it was pre-pandemic with 7 million less workers. There's massive productivity. Yeah. Look at the profitability that's happening that's going to sustain capital spending into next year as well. We've got inventories at very low levels that need to be built. So there's a lot of sustainable force for growth.
Jim, you're closer to Dearborn than me. Why did you tell me to buy Ford at the bottom, the bottom of the pandemic? It's up 240%.
I didn't buy it either, Tom.
Okay, there we go. Jim Paulson and the Triple Leveraged All Cash Fund as well. Romaine, this is a precursor to what is to come, and you have been dead on this. These earnings are going to come out, and we are going to adjust. This morning, Ford Motor adjusts.
Yeah, Ford Motor adjusts. You're referring to the forecast that they're giving out here. Of course, you're seeing at least the metrics they're using with regards to EBIT and EBITDA improvement here, significantly better here than what we saw in Q2. That's the word coming out of management here. And a lot of this really isn't just about sales, Tom. This is really about their ability to sort of manage this
to manage it, exactly.
Yeah, absolutely. And they're talking about, so you're talking about margins, you're talking about better costs here for the company, and you're talking about more favorable terms for them with regards to their credit operations and a lot of other operations there, Tom.
Romaine, I'm sorry. I just see you in a 2021 Bronco Sport. I mean,
I'm looking at the prices, right? And that is kind of key. Well, that's exactly it, right? I mean, they're actually able to jack up the prices. Yeah. That's where inflation has happened. A Bronco Sport is starting at $27,215.
That's it? No,
I don't think that this is recent.
No, that's not
2021, the Explorer starting at $49,000. I mean, honestly, the inflation has been pretty off the charts, Tom.
Yeah, a Ford F-150. I mean, you get one of those souped up, Tom.
Good news spin here on Dearborn, and Lisa's glooming it up with the price of cars.
The pendulum of car inflation. I'm doing it for you, Tom. I can
maybe
hear
there's
your
going
voice
to be
in my
inflation,
head.
but seriously, folks, this is a big theme here, and I would suggest Jerome Powell, guys, knows this. Corporations will adapt and remain, as you say, they lead with cost responsibility.
Yeah, good ones will adapt, and the ones that have good management will adapt. We saw that very vividly during the COVID crisis here, and the companies that managed to navigate that. Coming out of this crisis, and with a rate normalization here, you're going to get another test of which CEOs really know how to get it done.
Romaine, I remember you on the phone.
You do.
In late March of last year, you were buying 10,000 shares of Ford at like $5 a share.
Yeah.
It's tripled.
Triple. Well, we did well. We did well, Tom. Yeah. The nutmeg drinks are on me tonight.
That's what he was trying to go for. You got his. You picked up the message. There you go.
5 to 15 on Ford. Good news out of Dearborn. Maybe that is a precursor. Coming up, the interview of the day. Michael McKee will give us, after 3 questions yesterday, Michael McKee will give us 3 answers on the economic data coming out. Stay with us. Futures, -19. This is Bloomberg on radio, on television. Bloomberg Surveillance. Good morning, everyone on radio and television. Lisa Abramowicz and Tom Keene. Romaine Bostikin for John Ferro today. He slept off his rude questions to Chairman Powell yesterday. The last questions of the press conference, but the first analysis of today's economic data are Michael McKee, head of all of our economics. Michael?
Well, the Fed was a surprise yesterday. Jobless claims are the surprise today. Jobless claims rise to 412,000. The previous week's level revised down to 375,000. So kind of a significant rise in jobless claims. I don't have a good explanation for you, but we are still way off the highs of a year ago. So there is improvement, and maybe this is just noise. But what is important here is this is from the week that is the survey reference week for the jobs report. So it could be that we see some problems in the jobs report, and that's been something that the Fed has been watching. Philadelphia Fed, though, comes in just a touch below where it was at 30.7. That's down from 31.5. So still some good news in terms of manufacturing in the Philly.
The subterfuge here is too much. Lisa wants to get in, but I got to ask the rude question. Did Powell know this data at the press conference?
No, he probably did not know the claims data. And I don't think the claims data would make a huge difference to the Fed. And the fact that we saw claims rise by 37,000.
Come on, Michael.
Okay.
Give me some romance
some
here.
Juice.
Powell knew.
You want
some
Powell
juicy
knew. Stuff. But they told him under the table, and he bought Ford, right? Like
Okay. Well done, Michael McKee. All right. From fiction to fact, Mike, we're looking at this number, this idea here of 412,000 new initial jobless claims at a time when we do have an economic recovery. How does this sort of speak to the fact that a number of states have ended enhanced unemployment benefits with the expectation that that would actually juice employment, would push more people into the labor force?
Yeah, I would have to research this because I know there were a bunch of states, maybe 18 states that were going to end it, but I'm not clear on what date. And I do believe it was sometime like the 1st of July, so this may not have had an impact.
Some of them did. I believe 5 of them did on Saturday. But it just sort of pushing forward this idea of whether that would have potentially affected this.
Maybe, this could have been one of those by the rumor things where people see the fact that they're going to lose benefits, so they're going to go apply quickly before the benefit program is taken back.
So the longer-term trend line here. Mike?
Well, the longer-term trend line, you look at the total number of people who are getting benefits, and this is delayed by 2 weeks, but it's down to 14.8 million, which is still an awful lot, but that's down from 15.3 the week before. So we are seeing people come off the rolls. The question is, how quickly do they transition into the labor market? And that's the problem, is we don't know if they are going to join the labor market and start looking for jobs.
You got 3 non-answers yesterday to your 3-part question at the end. People out in my zeitgeist are still talking about McKee's rudeness yesterday. What did you learn from the chairman in his delicate non-answers?
Well, I think he did basically concede it's really hard to know what the numbers are going to be because we've never been in this situation before. Now, the other thing that he said that was interesting was they were going to act regardless of the markets. And, of course, we saw a little bit of reaction in the markets, but no huge taper tantrum because they were willing to risk that.
You're the only one that knows. What's substantial further progress? That's in that's not in Abel Bernanke. That's not in Mankiw. That's not in Krugman 2 volumes. What is this foolish phrase, substantial further progress?
It's I've used this line before, but it's basically like Potter Stewart's definition of pornography. I can't tell you what it is, but I'll know it when I see it.
Can we say that on radio?
That's basically what the Fed is saying.
Michael McKee going rogue.
Let me note something here before we go. Prices paid in the Philadelphia Fed go up to 80.7 from 76.8.
That's a diffusion index off 50?
That is. And that is, I'm just checking to see if we have that is the highest since 1979.
That's right where I'm going. Michael McKee, brilliant. That's what we love Michael McKee for, folks, that historic perspective. That's a perfect movement to Michael Schumacher joining us from Wells Fargo. Michael, I got to go right there. We're going to rip up the script. I mean, McKee getting us back to the 70s and back to that inflation. When does this not become transitory? That's a wow statistic on prices paid, folks. 50 is normal. We're up to 80. That's a huge surge in Philadelphia inflation, isn't it?
It's an enormous number, Tom. And the inflation prints have been huge all over the place. I love Mike McKee's question of Chair Powell yesterday. And the Fed doesn't know either when this transitory notion is going to go away. I was amazed to see the Fed's estimate for inflation this year go up by 100 basis points in 3 months. What does that tell you? They just don't know either. We don't know. The Fed doesn't know. It's getting pretty scary. The markets are getting concerned.
When you looked at the dots, or rather the general interpretation of those dots yesterday, Mike, did it provide any more clarity for you?
It made us think, Romaine, that people in the FOMC are getting a little bit skittish. They've got this new framework. It's not battle tested. Who knows how it's going to play out over the next 6 months. But I think if the Fed truly is guided by data, it has to look at the inflation prints and say, well, these are actual data. They're going up a lot faster than we expected. Therefore, it makes sense to pencil in a rate hike or two 18 months down the road. It seems pretty straightforward to us.
Are you worried at all about the possibility that the Fed might already be behind the curve here with regards to inflation?
Yeah, I think the interesting thing here, Romaine, is the Fed is redefining what it means to be behind the curve. So the Fed says it wants to let inflation run hot, hasn't really defined what exactly that means, won't tell us what the time frame is to calculate the average for average inflation. So you can't really determine exactly how far behind the Fed is. But if you were to compare the Fed today, let's say to the Yellen Fed or the Bernanke Fed, yes, the Fed would be way behind. So the markets are trying to assess just what exactly that means in terms of inflation pricing, break-evens, and ultimately interest rates.
Mike, we've been talking about how the Fed is acting as a monolith in many ways, very differently to the ECB, which is more fractured with the members. However, this particular meeting highlighted increasing dissonance between members, increasing disagreement between the different central bankers in the United States. How much does this color how you see the Fed acting going forward?
Yeah, it's a great point, Lisa. I think what it really does is introduce a lot more uncertainty into the Fed's policies going out especially 6 to 12 months. If you look at the dispersion of those dots for Fed funds out in 2023, it's incredible. You can talk about a consensus. There isn't one. The FOMC does not know exactly how this is going to evolve. Therefore, it's a little bit much, I would say, for the markets to latch onto a particular path. What that means is volatility might tick up. Investors probably should protect themselves against yields rising not just a little bit, but potentially a bunch, because the FOMC could shift gears pretty quickly.
I got to make some headlines here, Michael Schumacher. Let's do that at Wells Fargo this morning. You're not managing for total return. Are you talking about a bond bear market?
Yeah, the bond bear market's here as far as we're concerned, Tom. People have gotten all worked up about yields not doing much over the last 3 months. I get that. It's been a tight trading range. But still, if you think about yields over the course of 2021 so far, 10-year Treasury is up, 65 basis points, something like that. We think it probably ends the year above 2%. That's a bear market in my book.
It's a bear market in your book, and sometimes in bonds we don't see that. Are we going to see emotion out of that bear market? Romaine Bostick, it's a bear market in the equity market. The close becomes a soap opera. What are we going to get out of the bond market? How do people respond to price down, yield up?
Yeah, not a very good cocktail, frankly, Tom. When you think about it, one concern we've had for a while is we will actually see an exodus from mutual funds over time. And our work tells us that it takes a couple of quarters typically. Yep. So I think probably mid-July is a good time frame. People start to get those statements. They see a lot of red numbers next to their bond funds, and they say, hey, wait a minute, this is not what I expected. I should reconsider.
This is the most important comment of the day, even better than what we heard from Michael McKee. Lisa Abramowicz, it has been so long since we've had a legit bond bear market. Mr. Schumacher absolutely nails it. You get one statement, rationalize. Two statements, rationalize. Three statements, you figure out how much yield you've lost over, 3 months, 6 months, 8 months. Boom, that's a bear market. Well, money moves.
The only argument against that actually occurring is, or not the only, but one of the arguments against that is that Fed Chair Powell was thought to be the central banker to the world. And now the central banks of the world, perhaps schooling Fed Chair Jay Powell. Can Treasuries sell off Michael Schumacher? And can we get that bear market without a substantial move, without rate hikes in other regions, the ECB, the Bank of Japan, and elsewhere?
Sure. We get this question in various forms, Lisa, quite a bit. And really it boils down to yields are low everywhere. Central banks are super accommodative. Can the U.S. sort of go it alone in terms of yield increases? And we think the answer is yes. First of all, the Fed is not leading the way in terms of rate hikes. Other central banks are. Norway said today it's likely to hike in September, for instance. And also, if you look at yield spreads, let's say in 10-year space, they have been very, very much wider than they are today when yields were quite a bit higher. Good example is late 2018. The 10-year Treasury was about 325. At that point, the German Bund was maybe 40, 50 basis points positive. A huge gap between the U.S. and Europe, and yields can go higher, we think, from here.
Does the dollar, though, cooperate with that general plan, that outlook, Mike?
Yeah, it's interesting, Romaine. We had been dollar bears for a while. The news yesterday makes us rethink that a bit, but only for a little while. So if you consider, again, the relative positioning of the central banks, the Fed became more hawkish. Other central banks, though, are quite a bit more hawkish still than the Fed. So we think the dollar gets a pause, maybe a bit of a relief rally here, but probably not a huge bull run for the U.S. dollar.
Michael Schumacher with us as well, and we're going to bring in here to advance this conversation forward, our Michael McKee, head of all of our economics as well. Michael McKee, how does a bond bear market change the Fed dialogue? Alan Greenspan would make clear we're wired from a Fed policy into the stock market. President Trump, of course, knew that very well. How does a central bank react to price down, yield up for a good length of time?
Well, I guess to continue the metaphor, it depends on whether it's a baby bear or a big mama bear. The baby bear, the fact that the prices have adjusted to where they are now is not a problem at all for the Fed. It's an expected adjustment. The question is, do they keep going? Do we have a taper tantrum? It doesn't look like it so far. And what's interesting is you look at the break-evens, 5-year break-even dropped off a table yesterday because there is a belief that the Fed will get this right and that inflation will go away, it appears.
Lisa,
Michael,
it's like the pendulum of Goldilocks.
Well, yeah.
We're back there. Big bear, little bear, the whole thing.
Well, yeah, Michael Schumacher, what is the nature of a baby bear versus a mama bear?
She said with a straight face.
I couldn't say it with a straight face. Michael Schumacher, please save me.
Just a little bit less bite, I think, is probably the bottom line there, Lisa. So people talk about this notion of yields rising gradually throughout the year. It's fine. I think that's probably a decent possibility. But still, back to the point of investors looking at their statements or portfolio managers recalculating their performance every day, eventually that grinding bear market becomes a pretty poor performance. And you still have to look at it and say, well, okay, so if yields go up, let's say 50 basis points over 6 months, as opposed to 50 basis points over a month or two, yeah, the 6-month thing is a bit easier to take, but it's still negative return. It's still not very good. You still want to get out of the way.
Let's say we get to a stage here, Mike, where we start to see correlations break down between the bond market and the equity market. And when I say break down, I mean return to what would normally be normal here. Is there still a reflation trade out there, so assuming that the Fed moves in the way that the market is looking at right now?
Yeah, probably the function there to consider, Romaine, is just how much the equity market takes a hit. So I think a classic reflation trade people might consider is getting long stocks, but it really is key here to think about, does the Fed act very quickly? Does the Fed throw in 75, 100 basis points over, let's say, 3 to 4 meetings? So does it hike every single meeting for a while, or is it a much more gradual approach? If it's gradual, the equity market can probably hang in. If it's much more of a let's try to get back in front of this inflation thing, equity market takes a hit, there's probably not a great reflation trade at that point.
Michael, this has been wonderful. Thank you so much. Michael Schumacher, just brilliant there on the price dynamics of fixed income. So, Lisa, what'd you learn there?
I learned that people are expecting a bear market still, and the idea here of the virtuous cycle of foreign money circling back into the U.S. may not work out that way.
What do you got in the 9 o'clock, Lisa? You're going to drive the dialogue forward there.
And we're going to drive it in a very Bostickian way, talking about meme stocks with Jill Carey Hall of Bank of America. She's U.S. equity strategist. I'm curious to see what the Fed's hawkishness does to some of these fads that we've seen in markets. Will they remain fads, or will they become more entrenched trends?
She brought up the dreaded meme. Romaine, give me a meme update. I really don't want it, but let's pretend.
Well, I mean, I know you're still stuck in AMC here, Tom, but, you know, not looking too good today. Down a little bit more on the day. Down about 4% here in the pre-market.
That's all you're going to give me?
That's all I'm giving you for right now.
I mean, I got no GameStop love or AMC.
Well, BlackBerry's down. They're all down.
Can you explain why Cleveland Cliffs is a meme stock? I still don't understand that.
I don't know. It's iron ore pellets, Tom. The
kids, iron ore pellets is
it's all the rage with the kids these days.
Really? Iron ore pellets is the rage?
It's the idea of nostalgia.
I thought you left.
Millennial nostalgia. Yeah, I haven't gone yet. When you release me, I'll go. Am I released? Maybe
you are so released.
May I have a hall pass?
Okay, right. You have a hall pass. Yeah.
Thanks.
Lisa Abramowicz to drive the conversation forward at the 9 o'clock hour as well. Futures -16, Dow futures at -105, and the VIX has really changed. We haven't said enough about that with the VIX from a 15 level up to 18.64. I mean, Romaine, it's like tangible.
Yeah, I mean, well, yeah, tangible. It's still below some of the longer-term averages. But, yeah, the little pop that we're seeing in the VIX, definitely something to keep an eye on. You're almost at 19 here. Yeah. And the idea here, Tom, is whatever happens here over the next month, or excuse me, over the next year, as I say, next 18 months here, it's going to be a little bit rocky, a lot more volatility ahead.
I just want to go home. I mean, I'm exhausted after yesterday. I thought it was a snooze fest, and all of a sudden, McKee's fulminating about surprises and the rest of it. We have much more to come this morning. Good conversations. Stay with us on radio, on television. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Officials at the Fed now signal that they may raise interest rates from near zero faster than they had forecast. Policymakers expect there will be 2 rate hikes by the end of 2023. Fed Chair Jerome Powell acknowledged there is a lot of uncertainty. Powell said there is a risk that inflation will be higher than what the central bank thinks. President Biden plans to sign legislation today that will make June the 19th a federal holiday celebrating the end of slavery. Juneteenth will be the 12th federal holiday. It marks the day in 1865 when Union soldiers brought word of freedom to enslaved people in Galveston, Texas. In Germany, the head of Angela Merkel's party welcomed President Biden's trip to Europe. In a Bloomberg webcast, Armin Laschet said the world's problems can only be solved with a multilateral approach. Laschet is bidding to succeed Merkel after September's elections. And in Italy, government officials say the economy could grow well above that 5% this year. That's faster than the latest predictions by the central bank, the OECD, and the European Commission. Italy was hit hard by the pandemic. GDP fell almost 9% last year. And it's a milestone for China's space program. A Chinese spaceship carrying 3 astronauts docked with the country's new space station today. The crew will live aboard the space station for 3 months. They'll carry out experiments, test equipment, and conduct maintenance. And police in Hong Kong have arrested the 3 top editors at the pro-democracy Apple Daily newspaper. 2 of the paper's executives also were arrested. They're accused of breaches of the sweeping national security law. The paper's founder, Jimmy Lai, is already in prison for attending unauthorized protests. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We have 70,000+ people, and we're concentrating on getting them back to work because that allows people to move about under the CDC guidelines without masks and things like that. As more people get vaccinated, we keep bringing more back. We've got a lot of work to get those back. But the view is after Labor Day, our view is all the vaccinated teammates will be back and will be able to operate fairly normally, and we'll then start to make provisions for the other teammates as we move through the fall.
Brian Moynihan of Boston, of Charlotte, and I might point out the Bank of America of the city of New York as well. We welcome all of you on Bloomberg Radio, Bloomberg Television. Particularly good morning to Bloomberg 1130 in this city of New York. Romaine Bostick and Tom Keene. And we visit again with, I'm going to suggest, someone riding high. Eric Adams joins us, the mayoral candidate in the June 22nd primary. And this has a national, I should point out, really a national view as well as what we see. I was thunderstruck, Eric, and I don't know where you came in on this, but in the debate transcript I looked at, once again, the fancy suit and ties have a middle-class definition of $137,000 income per year, and one of the candidates said, wait a minute, it's more like $54,000 a year. Explain to me, if you are mayor, where your middle class is. Define middle class in your New York City.
Well, and that's a moving target. As I stated during the debate, when you looked at the United Way's report, 40% of New Yorkers have a sufficiency deficit. So if you have a family of 4 and you're making $150,000 a year and you're living in Park Slope, you are challenged to actually make ends meet. And there are many parts of the city where, based on your income, your family, your rent, and dealing with everything from student loans to tuition, it's a very difficult time for middle-class New Yorkers, and we have decimated the middle class in this city, and if not throughout the entire country.
Part of the decimation of the middle class is their fear of crime. Certainly, we've learned at Bloomberg in the last number of weeks, crime is front and center. There's a lot of people talking. Eric Adams, I would suggest, wore the blue, was a police officer. I want you to provide the distinction of your approach to NYPD versus the candidates who don't have your public service.
And that's a great question, because many of the candidates refused to talk about this real issue of crime. They wanted to look at public safety through the eyes of a bumper sticker or a slogan. Let's be clear. The prerequisite to prosperity is public safety and justice. We're not going to recover as a city or a country if we don't get this crime under control. No one is going to come here as a tourist, a multi-billion-dollar industry. If you have 3-year-old children shot in Times Square, no one wants to ride our subways to get back into the office spaces if you're slashed or shoved to the subway system on the subway tracks. And so my goal is, number one, get gun violence under control. We want to put in place a plainclothes anti-gun unit. We will zero in on gun and gang violence, use our gun suppression unit to really collaborate together with our other agencies to identify who's using the guns, stopping guns from coming into our city. And then we must deal with our street homeless problem, really dealing with the mental health illnesses that we're facing. We're losing the quality of life. No one is going to stay in the city or build in the city if we're viewed as a city that's not safe.
Certainly so, Mr. Adams. Obviously, a prerequisite to that prosperity is public safety. So is education here. A lot of folks want to know what's your approach going to be with regards to the public school systems here, with regards to staffing, and more importantly, with regards to the prosperity of our children.
Well said. Well said. Listen, let me tell you the biggest embarrassment in this city is how we're treating our children in education. Education is not K through 12. That's wrong. The neurologists and pediatricians would tell you education is pregnancy through profession. We must make sure that every area of education is handled right, everything from nutrition when mothers are pregnant to the time that we give them the right tools they need in brain development, but also the real embarrassment. 65% of Black and brown children never reach proficiency in the Department of Education in the city. So, one, we must return the joy of learning in our schools. We must look into internships, externships, lean into vocational trainings, allow the business community, our tech and other industries to be part of the curriculum that we develop in our school systems. And then we must get technology in our schools, access to Wi-Fi and all the tools our children need. And finally, our funding should not be based solely on what happens in a school building.
Right.
We need to look at the issues around the schools as well.
Is your vision centered around the public school system, Mr. Adams?
My vision is surrounding lifting up excellence. If that means charter schools, public schools, private schools, let's duplicate successful schools in our city and go across the country to do so.
I got 45 seconds, Eric. How are you going to cut costs? How are you going to manage costs in a city where costs are unmanageable?
Our city is dysfunctional, as cities across America, they are. Number one, we're going to rein in a 3 to 5% cut in all of our agencies. There's a lot of fat. We have a $20 billion increase in our budget. There's just too much waste and mismanagement, and we're not going to hurt those communities that were hardest hit during COVID and even pre-COVID. This city is manageable. Taxpayers are doing their dollars, doing the right things by paying their taxes. It's time for us to do the right thing with government by using those dollars correctly. We're too expensive, too bureaucratic, and too difficult to do business in this city, and that's going to change day one.
He is from Brooklyn, Eric Adams. Thank you so much for joining us. June 22nd, the mayoral effort here with that very unique voting as well. Romaine, I got to get out here and there's no Fed meeting today, Romaine.
No,
I don't know if they briefed you on that. But I look at the equity markets and you know what, Romaine? I'm going back to the Ford Motor Company. You wonder, is that the beginning of 1, 2, 5, 30 resets of where we are in corporate America?
I think so. And keep in mind, a lot of the sort of laggards that we saw over the previous few years, some of the, I guess, old economy stocks, if you will, have sort of found their mojo here. Ford, of course, being really emblematic of that with regards to the EV space and the idea now that they do have a future here that is going to go beyond just combustible engines here, and they are going to be a force to be reckoned with. And you're seeing that in a lot of other industries, Tom. A lot of companies really stepping up.
What'd you learn from Brian Moynihan?
Deposits, Tom.
That's it.
Take it out of the mattress. Help them out.
Okay, well, I'm triple leveraged.
Yeah.
I don't know. I mean, I got to clear the leverage if I want to go talk to Mr. Moynihan.
All right.
Romaine Bostic, thank you so much. Look for Mr. Bostic holding court on the close this afternoon. Futures, -13. Again, the VIX really frozen here. We'll see how the VIX opens up here in 35 minutes. 18.56 on the VIX. 10-year yield, it's changed, 1.55%. Good morning on radio, on television.